give back, which was also unique. And that's also why we all clicked so well, because I also was a fan of giving back to the community, giving back via charity, gratitude, like, going back to those traits that you want on your desk. You want gratitude. You want grit, you want gratitude, you want uh, people that will help push you, right? Like, the dream trainee is not just someone that succeeds, but someone that helps you be better as a trainer. They motivate and inspire you. Like, the more you can work with top guys and top people, and that's the beauty of what I do now with all my little baskets and areas of the work I do. It's incredible because I'm solely surrounded with people that I love working with, right? And it's people that push me to be better, people that I learn from. And you just can't put a price on that. Like, the effect that'll have over 5, 10, 20, 30 years. Like, how much of a better person do you become when you're with these people?
It sounds like you are reaching out and still fostering relationships, and is that accurate?
Yeah, yeah, for sure. And ideally, I'm just trying to also relay a lot of the ethos that would have been like, look, if I was managing an office and you were in it, well, what would this look like? And yeah, you get the information. Then I always laugh because there's these people on Twitter that are like, how would you make this daily report card apply to Forex? And it's like, dude, like, you tell me, like, you put the work in. I like, okay, like, how do I find a mentor? How do I add value to them? It's like, you tell me. And a good one was someone asked me about the Bollinger Bands, and I'm like, look, this is what they're set to. They send a screenshot of their software. What do I need to put in on this? It's like, bro, like, what do you want me to do for you? Like, because I hate helplessness, right? Like, you don't want the trainee that is going to be like, how do I restart my computer? How do I do this? It's like, bro, like, you've got Google, you've got a brain, like, try your best to figure it out. Like, you should only come to someone once you've tried your best to figure it out. Like, struggle a little bit. Like, people are so afraid of struggling. Like, you can't be afraid of discomfort. You can't be afraid of struggle. You need to embrace it. Fail a couple of times. Like, people are, you just can't be afraid of failure. You can't be afraid of banging your head against the wall. Like, yeah, I don't know, try something. Like, I'm a huge tinkerer. If something's not working, tinker, adjust, reflect. Did it work? Did it, like, what other change? And then just iterate. And so many people, like, like, click your screen and see what happens. Change this DRC and see what happens. Reach out to a mentor. And if they ignore you and don't reply, guess what? Figure out what you could have done better. Scour the internet. What makes a good cold email and stuff. And it's so self-selective, right? Because, like, the people that do that, you're setting yourself up for success. And, like, it's funny, just with the interview process, so many times it's like, by definition of you not doing X, Y, or Z, like, I actually have my answer already, and that's always interesting too.
Yeah, no, I think that's extremely helpful because there are a lot of people that I see on Twitter and elsewhere that are asking for the answers rather than positing the results of their research and then asking maybe a mentor if they could, analyze the
Yep.
work that they had already done. It seems like it's more, a person could achieve their goals a lot faster probably and maybe make a lot more trading friends and maybe meet a mentor if they're putting the work in themselves and maybe asking for thoughts rather than trying to just
Yep.
use an experienced elite trader as a personified Google.
And that's, yeah, and that's the funny part, because the paradox too is you get the right answer faster and better in the short term, but you're hamstringing yourself in the long term, right? Because you aren't teaching yourself to fish. You aren't right. There was, when I was struggling, my trainer was giving me the strategies and I was observing, I was learning, but, like, there was nobody out there that was going to figure it out for me. There was nobody out there that was going to be able to know what's going on in my head and figure out my specific issues. The only way I was able to do that was, like, I struggled. I struggled and I reflected and I thought and I put the time in to figure out, like, what is not working here. There was, in so many things with like with life, friends, relationships, work, whatever. It's like there is no Google for like, hey Google, what job should I take, or like what should I do to find fulfillment? There's nobody that can answer that, right? Let alone Google. And yeah, the people I think that end up going the furthest are the people that make sure they're just it's like this weird thing where you do better with working with others, but in order to be working well with others at a high level, you need to be self-sufficient as well.
Yeah, no, I think that's extremely, extremely powerful. And I'll just insert the caveat that I'm pretty sure we would both make, which is like there are a time and place for questions. Like questions are important. Like I don't want anyone to think that we're
Oh,
like
for sure. Yeah.
bashing questions for the sake of asking questions. Like,
But it's struggle first. Bang your
yeah,
head against the wall.
yeah,
Just
yeah,
make an attempt, and then uh,
yeah.
try. Just don't be dependent on others until you need to be.
Yeah, yeah, and I think being an optimist myself, like there is a lot of like hope that people can actually achieve a lot on their own. But they might not think that they know the answer to something, but that they could definitely do the work, and they probably figure out that they'll get themselves like to an answer that they're relatively comfortable with if they just do the work and do it.
And it's such a powerful thing also to throw it back on people and say, what is your answer to this? Right? Because you force them to think. And so often, like, they might bring up something that you weren't even thinking of yourself, or they might come up with some. You want to know what I love about some of like the high level kind of like elite group work is one person will have, and you can see this in all these like team meetings and team reviews and other meetings I'm a part of, where one person will have an idea and you'll be like, oh, like that's a great idea. And then someone is like, oh, wait, like based on that idea, like the next logical jump, you go from A to B. Then someone else thinks back and you're like, wait a second, like based on my experience, like, oh man, like this point B actually brings us to C. And all of a sudden you're like, holy crap, like I can't believe we just made it to C. And if you took those individuals, if those individuals were on their own, nobody would have ever made it to point C. And I help with my friends are doing kind of this small business lending startup, and we were on this call, and there was just like a business operations problem, and it was exactly that, where one guy said something, some guy said something else, and then I'm like, holy crap, like this is the missing puzzle piece, and like we ended up at this end place where like you can't do that unless you have a group, and unless you have a group where each member is thinking and contributing.
No, that's extremely powerful. That's extremely helpful. One topic that I wanted to touch on as well, sort of on this, you know, in the breadth of like trader development and questions that traders typically ask. You've seen and worked with and mentored and coached a lot of traders, and so I'm curious, what are some of the most common, issues and questions that you see from traders, and how hard is it, or how long does it take, for someone to fix some of those issues, or get through some of, those questions that people have, which lead into larger issues?
Yep. And so, man, I would say I've seen people struggle with everything under the sun. Um, Everyone comes in with their own personalities, their own experiences, their own tendencies. There's people that are extremely risk averse. Then there's people that are just gung ho, shotgun approach, trade everything and burn through a bunch of money. And it's kind of funny because I think when you start with a raw, fresh trader, it tells so much about that person. Who's the person that's like willing to immediately just jump in and get trading? For me, it's like, oh, let me read the manual first. I'll just read the trading manual, then maybe I'll place it, like, because that's just my personality. And then you find the people that like the thought of risking $5, all they can think about is a $5 bill or a $20 bill or a $100 bill. And for whatever reason, uh, I think something that helped me was like, not that I had money at the time, but like for me, money, the P&L was always just, it was just a number on the screen. I never thought of it as money. And like, you would get these guys and they just couldn't detach from, oh my God, like if I lose 200 bucks, that's 200 bucks out of my pocket. And you can never have, you can never achieve as much if you're always tied to that. You know, it's a chain weighing you down. Not that you can't be successful, but you can't jump as high until you say, like, I'm free from this need. I don't need this money. And then you have people that overtrade and almost like some of the gamblers where they just need the action and they need to be proven right. And there will be people where you're gonna like, probably one of the first indicators, is this person going to make it, is when you give them a playbook and you say, the first step to learn anything is, this is our playbook. Everything else is not going to work. Just trust me. Everything else you do, like, ooh, stock's going up, I think this is a buy, that's a sell. Everything you do is going to fail. It's not going to work. But in these couple situations, these very niche situations where nuances A, B, C, D, and E are true, you're going to have a little bit of edge there. And when A, B, C, and D are true, the way to capture it is you buy here, your stop is that, and that's the trade. And so quickly, you see the people that are able to say, like, okay, I trust Lance. I'm going to explicitly follow that instruction. I understand that if I don't do what Lance says, I'm going to lose money. And if I do it, maybe it's going to make sense. And so many people, then when you're released, like, okay, you know, stock of universe of stocks, go do what I just told you. There's the people that do the trades anyways, and you say, hey, why were you doing that? That didn't fit A, B, C, and D, right? Like, you know, C is this. Well, it doesn't fit C. And they're like, yeah, but you know, I kind of thought it was going to go up because you know, the market felt like it was ready to pop. And you're like, yeah, but how'd that work out for you? Then after like 10 reps and they're losing money, you say, hey man, like, we've got all these data points. Like, what you're doing isn't working. Like, want to just kind of like just listen to what I'm trying to teach you? And so many people can't do it. It's, and I don't know if it's like an ego thing or the need to be right and smart, but that's really common for a lot of traders where like, and even at the elite level, a lot of people have these ideas or theses in their head or these views, and that's not where I've seen anybody ever make money. The place where people make money is you have these ideas, but the technical pattern and the chart and everything is confirming it. Like, it's fine to have a bias. If stocks are down 30% in 3 days, I'm not going to be thinking, ooh, this might be a good short. Of course, you're going to be long biased, right? But until that setup reveals itself, until A, B, C, and D show itself and fits your playbook uh, to confirm your long thesis, that's where the money's made, right? When thesis meets setup and meets price action, that's where people do well.
If you liked this video, don't forget to hit the like, subscribe, and notification bell. Thanks for watching.
Two parts to the answer. First, as we discussed earlier, we balance risk across multiple independent drivers. We avoid having too much of the portfolio concentrated in any single driver. Second, we have stress tested our strategies through multiple time frames and multiple scenarios. I think many people experience drawdowns that are much larger than they expected because they never really understood how their strategy would have worked in different environments. There are managers who have been in the business for 5 years and think, I have a great track record, this approach really works. But they really don't have the perspective of how their strategy would have performed in different circumstances. Strategies that are based on a manager's recent experience will work until they inevitably don't work. In contrast, we test our criteria to make sure they are timeless and universal. Timeless means that we look at a strategy during all different times, and universal means that we look at how a strategy worked in all different countries. There is no reason why a strategy's effectiveness would change in different time periods or when you go from country to country. This broad analysis through time and geography gives us a unique perspective relative to most other managers. For example, to understand the current U.S. zero interest rate, deleveraging environment, we need to understand what happened a long time ago, such as the 1930s, and in other countries such as Japan and in the post-bubble era. Deleveragings are very different from recessions. Aside from the ongoing deleveraging, there are no other deleveragings in the U.S. post-World War II period. Are there risk limits in terms of individual positions? There are limits in terms of position size, but not in terms of price. We don't use stops. We trade approximately 150 different markets, where I am using the term market to also mean spread positions, as well as individual markets. However, at any given time, we probably have only about 20 or so significant positions, which account for about 80% of the risk and are uncorrelated to each other. When you are in a significant drawdown, do you do anything differently? Do you reduce your exposure? I don't believe in reducing exposures when you have a losing position. I want to be clear about that. The only pertinent question is whether my being in a losing position is a statistically meaningful indicator of what the subsequent price movement will be, and it is not. For that reason, I don't alter positions because they are losing. Is the implication that whether you are at a new high or you are down 15%, you will still size positions exactly the same way? Yes, the positions taken and their size would be exactly the same. If a position works poorly, does that cause you to re-examine your strategy? Always. The best discoveries come from positions that don't work out. For example, in 1994, we were long a number of bond markets, and the bond market sold off. We have multiple rules and systems that apply to the bond markets, and at the time they indicated a net long position for each bond market. Afterward, we realized that if we took those same systems and traded them on a spread basis rather than an absolute basis, we could produce a much better risk/return outcome. That change took advantage of the universal truth that you can enhance the return/risk ratio by reducing correlation. If there is a research insight, we change our process. That is an example of how a losing position caused you to change your process. But what about an individual position that is losing money? I understand that you do not get out or reduce a position simply because it is losing money, but what if you change your mind because you realize that you overlooked some factor or didn't give some factor enough weight? No, it doesn't work that way. The way we change our minds is a function of how that information passes through our decision rules. Our decision rules determine the position direction and size under the circumstances. So, your trading process is fully systemized rather than depending on discretionary decisions. It is 99% systemized. These systems evolve, however, as the experience we gain might prompt us to change or add rules. But we don't make discretionary trading decisions on 99% of our individual positions. What if there is some idiosyncratic event that is not incorporated in the system? If it is something like the World Trade Center getting knocked down, then yes, we may exercise a discretionary override. In most cases, such discretion would be a matter of reducing risk exposure. I would say probably less than 1% of trades might be affected by discretion. Is your process totally fundamentally driven, Or does the system also include technical factors? There are no technical inputs. So in contrast to the majority of CTAs who use a systematic approach based only on technical factors, primarily or solely price, you also use a systematic approach, but one based only on fundamental factors. That's right. What is the origin of the Bridgewater system? Beginning around 1980, I developed a discipline that whenever I put on a trade, I would write down the reasons on a pad. When I liquidated the trade, I would look at what actually happened and compare it with my reasoning and expectations when I put on the trade. Learning solely from actual experience, however, is inadequate because it takes too much time to get a representative sample to determine whether a decision rule works. I discovered that I could backtest the criteria that I wrote down to get a good perspective of how they would have performed and to refine them. The next step was to define decision rules based on the criteria. I required the decision rules to be logically based and was careful to avoid data mining. That's how the Bridgewater system began and developed in the early years. That same process continued and was improved with the help of many others over the years. Are the individual rules in the compendium of rules that make up the Bridgewater system sometimes revised, or do they remain static through time? They are sometimes revised. For example, we used to look at how changes in the oil price affected countries. Between the first oil shock and the second oil shock in the 1970s, crude oil was discovered in the North Sea, and the UK went from being a net importer to a net exporter. That event prompted us to change how we configured the decision rule that related to oil prices, so that when the mix of export and import items changed, the rule changed. How were you able to manage such a large amount of money without substantially impeding your performance? In fact, in 2010, you managed to achieve your highest return ever, despite having your largest assets under management ever. Most hedge funds end up having size-related difficulties managing much smaller sums. There are two major differences between us and most other hedge funds. Most hedge funds trade fewer markets, and they trade much more actively. We trade virtually every liquid market in the world, so the amount we have committed to any single market is small relative to our total equity. We also change our positions slowly. As you know, transaction costs are a function of the amount you have to move in a given time frame. Therefore, we have considerably more capacity than managers who trade fewer markets and turn their positions over more quickly. What is your turnover rate per market per year? It depends on what you mean by turnover rate. If you are defining turnover as moving from net long to net short rather than changes in magnitude, then the average time length is about 12 to 18 months. So it is a very slow process. Yes, on average. What about a year like 2008 when markets are witnessing huge price swings in a matter of days? In some years, the turnover rate might be significantly greater than in others, though in 2008 it wasn't much above the average. I believe you are thinking that we would be trading more during a volatile period, but that's not necessarily true. Our trades are driven directly by fundamentals and only indirectly by price to the extent that price changes make a market cheaper or more expensive. I guess then another reason why size may not be much of an issue, as might be surmised based on your huge assets under management, is that you will have a tendency to be a seller when the market is heavily bid and a buyer when it is heavily offered. While that is often the case, it wouldn't be true if the fundamentals were changing faster. We will trade in the opposite direction of the price movement if all the fundamentals remain unchanged. For example, if prices fall and the fundamentals didn't change, we would be buyers. But in practice, the fundamentals are also changing, so the direction of our trades will depend upon both changes in fundamentals and changes in price. But in a period like fall 2008, when markets were witnessing huge swings in a matter of days, largely based on shifts in sentiment rather than changes in fundamentals, I assume you would be more likely to be going in the opposite direction of most traders. Whereas most traders would be selling to cut their exposure when a market was breaking sharply, you would be more likely to be a buyer and have lots of liquidity. That's right, as long as there wasn't a bearish shift in the fundamentals as well. Do you ever run into situations where size is an issue? No, because we make sure we do not run into the problem of size being an issue. We know our transaction costs very well, and we know how long it takes for us to get in and out of positions. We will limit our position size to assure that we can get out reasonably quickly and to keep our transaction costs small relative to the expected alpha of the trades in that market. Is there a limitation as to how large you can allow the fund to grow? Yes, we have been closed for several years. But even if you are closed, in a year like 2010, your assets can grow dramatically just from profits. We returned profits. You did quite well in 2008, a difficult year for many hedge funds. What do you attribute your favorable 2008 performance to? Our criteria for trading in a deleveraging had already been established because we had previously studied other leveragings and deleveragings. Our analysis included both inflationary deleveragings, such as Germany in the 1920s and Latin America in the 1980s, and deflationary deleveragings, such as the Great Depression of the 1930s and Japan in the 1990s. I had also directly experienced the deleveragings in Latin America and Japan. We felt that if these sort of big events had happened before, they could happen again. We also believed that fully comprehending these events was important to understanding how economies and markets worked. 8 years before the deleveraging that began in 2008, we had developed and implemented what we call the depression gauge. It was designed to indicate when a depression-like environment was in effect based on a number of conditions coinciding, such as interest rates below a certain low level, contradictions in private credit growth, a declining stock market, and widening credit spreads. We knew that when the depression gauge was on, we would have fewer reliable indicators, with some indicators being impacted more than others. For example, if interest rates are near zero, obviously they can no longer be used as a viable indicator. We ran simulations of how our systems would have performed through both inflationary and deflationary deleveragings. If the depression gauge is triggered, our system rules and risk constraints are adjusted to fit the circumstances of a deleveraging period. It was obvious in 2008 that investors were heavily leveraged in carry trade positions. That is, they had bought higher-yielding assets funded by shorting lower-yielding assets. These positions would have to be unwound when the credit bubble popped. We also could see that the banks had leveraged up rapidly and carelessly. We anticipated they would have large losses because by reviewing their 10Ks, we knew the types of positions they held. By applying indicative pricings, we could mark their balance sheets to the market, which gave us insights into the negative implications for the economy and other markets. In short, by knowing how deleveragings occur, we could monitor the appropriate factors, and by understanding the cause and effect relationships in a deleveraging, it was not difficult to be well positioned in 2008. Besides being well prepared to trade through a deleveraging, we also didn't have the same vulnerability to a year like 2008 as most hedge funds did, simply because the inherent structure of our pure alpha strategy avoids embedded betas. In contrast, most hedge funds mix betas and alpha. The truth about hedge funds is that most of what is packaged as alpha is really beta sold at alpha prices. The average hedge fund is about 70% correlated with stocks. Why are most hedge funds so skewed towards strategies that do well in good times? I think it is human nature for people to choose strategies that worked well during the recent past, which implies a long bias. What is your big picture perspective of the current difficult economic situation facing the U.S.? Currently, we have a situation where there is a broad global deleveraging, which is negative for growth. Debtor countries that can print money will behave differently from those that can't. Countries that can't print money will experience classic deflationary depressions. Those that can print money, such as the United States, can alleviate the deflation and depression pressures by printing money. However, the effectiveness of quantitative easing will be limited because the owners of the bonds that are purchased by the Fed will use the money to buy something similar. They are not going to use it to buy a house or a car. In addition, fiscal stimulus will be very limited because of the reality of the political situation. So it is unlikely that we will have effective monetary policy or effective fiscal policy. That means we will be dependent on income growth, and income growth will be slow, maybe about 2% per year, because income growth is usually dependent on debt growth to finance buying, and I don't expect any significant private credit growth. A growth rate of 2% is not sufficient to meaningfully lower the unemployment rate. There is a risk that if the economy deteriorates, we won't have any effective tools for reversing the situation. The current situation is analogous to being in a recession and not being able to lower interest rates. If you had the power to enact policy, is there any policy that could ameliorate the current situation? The best policy would be to spread out the problems over a long period of time so that nominal interest rates stay below nominal growth rates. How do you do that? You do it through a combination of monetary and fiscal policies that produce enough government spending to make up for the reduction in private sector spending to keep the economy from contracting. Avoiding an unmanaged contraction is essential in order to maintain social and political order. At the same time, there needs to be well-thought-out debt restructurings because we can no longer allow our debts to rise faster than our incomes, and we need to gradually lower them. If you do more fiscal spending, it would further increase the debt. We are dependent on foreign capital to buy our debt. Isn't there a risk that increasing the debt further through fiscal stimulus might scare away foreign buyers of U.S. bonds? There sure is. That is why it is very important that the fiscal spending is used for investments that generate returns that are greater than their costs. We can't afford to waste money. Do you mean that spending should be focused on things such as infrastructure? Yes, put idle people to work on useful projects. It is also socially good. I think it is very bad for society for people to be out of work for very long periods. It is also a false saving. You are paying unemployed workers unemployment insurance and providing other safety net expenditures and generating nothing in return. Whereas if you pay people to build bridges and repair roads, at least you're getting something out of it and it has a multiplier effect. That's right. I don't like the giving money away option because it will devalue the currency and cause investors to run away from U.S. assets. The government should try to make the expenditures a good investment. Do you see a danger in the printing of money leading to inflation risk? Not over the next couple of years. However, longer term, whenever a country has a balance of payments, deficit, and depends on foreign capital, there's a risk that foreign investors will pull back if they fear currency weaknesses as a result of the increased printing of money. The first sign of such a shift is a shortening of the duration of bonds bought by foreigners, which further tightens credit. Such a response occurred in 1931 to 1933 when interest rates went up, even though we were in a deflationary depression. Under those circumstances, the central bank will normally buy more bonds to make up for the difference, which is a monetization of the debt that causes the currency to weaken and a movement of money into real assets and other currencies to escape currency weakness. This phase usually takes a couple of years. Initially, there is a move from deflation to a low level of inflation. For example, when Roosevelt decided to print money and go off the gold standard in 1933, the move depreciated the dollar and just negated the deflation. It didn't bring about a high level of inflation. During such times, both gold and bonds can go up together, which is very different from a normal situation in which higher gold prices imply lower bond prices because of the inflation component. This pattern is exactly what has happened in the current cycle when we have had monetary easing and seen both gold and bonds go up. When I read your description of long-term cycles, it sounded like the U.S. had gone through the fourth of the 5 phases, a country that still thinks it's rich but isn't, and is now in the 5th stage, a country in decline. Is that an accurate interpretation of your views? I believe so. How long does this cycle typically last? The entire cycle takes about 100 to 150 years. The 5th phase of a cycle, decline, lasts for about 20 years. Assuming the U.S. entered its decline phase around 2008, your cyclical model implies that the U.S. can remain in a general decline out to 2130. That is a pretty pessimistic outlook. Have there been any situations of countries in the decline phase of the long-term cycle where it hasn't been extremely painful? The decline of the British Empire after World War II wasn't cataclysmic because the adjustment process was spread out over many years. So was Japan's deleveraging. Essentially, a country's conditions can stay about the same for a very long period. It doesn't have to be terrible, but it can be terrible if it is badly managed. At Bridgewater, criticism is encouraged, including subordinates criticizing superiors. Do any of your employees ever criticize you? All the time. Can you give me an example? I was in a client meeting with a big European pension fund that was visiting managers in Connecticut. After the meeting, the salesperson criticized me for being inarticulate, running on too long and adversely affecting the meeting. I asked others who had been at the meeting for their opinions. I was given the grade of F by one of our new analysts who was just 1 year out of school. I loved it because I knew they were helping me improve and that they understood that that was what they were supposed to be doing. What do you believe is the biggest mistake people make in investing? The biggest mistake investors make is to believe that what happened in the recent past is likely to persist. They assume that something that was a good investment in the recent past is still a good investment. Typically, high past returns simply imply that an asset has become more expensive and is a poorer, not better investment. The tendency of investors to buy after a price increase for no reasons other than the price increase itself causes prices to overshoot. When investors are making money because they're greedy and fearless, which is typical after a large price rise, doing the opposite is a good idea. Dalio is a strong believer in diversification. In fact, he calls the potential improvement in return/risk through the addition of uncorrelated assets the holy grail of investing. He states that return/risk can be improved by as much as a factor of 5 to 1 if the assets in the portfolio are truly independent. Most people tend to focus on correlation as a primary tool for determining the relative dependence or independence of two assets. Dalio believes that correlation can be a misleading statistic and poorly suited as a tool for constructing a diversified portfolio. The crux of the problem is that correlations between assets are highly variable and critically dependent on prevailing circumstances. For example, typically, gold and bonds are inversely related because inflation, current or expected, will be bullish for gold and negative for bonds, because higher inflation normally implies higher interest rates. In the early phases of a deleveraging cycle, however, both gold and bonds can move higher together, as aggressive monetary easing will reduce interest rates, i.e. increase bond prices, while at the same time enhancing longer-term concerns over currency depreciation, which will increase gold prices. In this type of environment, gold and bonds can be positively correlated, which is exactly opposite their normal relationship. Instead of using correlation as a measure of dependence between positions, Dalio focuses on the underlying drivers that are expected to affect those positions. Drivers are the cause, correlations are the consequence. In order to ensure a diversified portfolio, it is necessary to select assets that have different drivers. By determining the future drivers that are likely to impact each market, a forward-looking approach, Dalio can more accurately assess which positions are likely to move in the same direction or inversely. For example, anticipate when gold and bonds are likely to move in the same direction and when they are likely to move in opposite directions. In contrast, making decisions based on correlation, which is backward-looking, can lead to faulty decisions in forming portfolios. Dalio constructs portfolios so that the different positions have different drivers rather than simply being uncorrelated. Bridgewater makes heavy use of spread positions to create holdings that have different drivers. For example, even though different world bond markets may be exposed to similar drivers, various spread positions between those bonds can have different drivers. The use of spread positions is critical in mitigating the problem of highly synchronous behavior between positions in the portfolio in an investment environment that is characterized by shifts between risk-on and risk-off, a situation where a broad range of markets move in tandem in response to whether investors are risk-averse or risk-seeking. Markets behave differently in different environments. The behavior of markets in deleveragings is very different from their responses in recessions. Any fundamental model that assumes static relationships between markets and economic variables will be flawed because those relationships can change dramatically in different market situations. For example, the same government actions that might lead to a sustained rebound in a recession might have little impact on a deleveraging. Dalio contends that any valid fundamental approach must be broad enough in scope, both temporal and geographical, to encompass all different environments. He believes such a timeless and universal approach is the only way to build a fundamental model that is sufficiently robust to represent the real world. Investors are often baffled when markets respond to news events in counterintuitive fashion. Dalio vividly recalls these experiences when seemingly very bearish events, such as the United States coming off the gold standard in 1971 and the Mexican default in 1982, were to his great surprise followed by major market rallies. In part, this seemingly paradoxical market behavior can be explained by the fact that markets often anticipate the news. The other part of the explanation is that bearish events can trigger new events with bullish consequences. For example, developments that have very negative implications for the economy and investor sentiment can prompt central bank countermeasures that lead to rallies. If there is a single essential lesson to learn from Dalio, it is that mistakes provide the path to improvement and ultimate success. Each mistake offers an opportunity to learn from the error and to modify one's approach based on this new information. Whenever you make a significant mistake in trading, write it down, both to reinforce the lesson and to serve as a future reminder. Then change your trading process based on this new experience. In this way, mistakes can become the essential ingredient for continual improvement as a trader, and for that matter, any other endeavor. Addendum: Ray Dalio's Big Picture View. Dalio's big picture perspective applies not only to temporal and geographical breadth, but also to viewing the markets and economies through the lens of long-term cycles and trends. Dalio's template for understanding economies consists of superimposing three forces that together explain the position and direction of any economy. 1. Productivity growth. Real per capita GDP in the United States has increased at an average rate of near 2% over the past 100 years as a result of productivity gains, but has fluctuated widely around this trend based on the prevailing long-term and business cycles. 2. Long-term credit expansion deleveraging cycle. Initially, the availability of credit expands spending beyond income levels, as Dalio explains. This process is self-reinforcing because rising spending generates rising incomes and rising net worths, which raise borrowers' capacity to borrow, which allows more buying and spending. The upwave in the cycle typically goes on for decades, with variations in it primarily due to central banks tightening and easing credit, which makes business cycles. Although self-reinforcing, the credit expansion phase ultimately reaches a point where it can no longer be extended. Dalio describes this transition in the credit cycle as follows. It can't go on forever. Eventually, the debt service payments become equal to or larger than the amount we can borrow, and the spending must decline. When promises to deliver money, debt, can't raise any more relative to the money and credit coming in, the process works in reverse and we have deleveragings. Since borrowing is simply a way of pulling spending forward, the person spending $110,000 per year and earning $100,000 per year has to cut his spending to $90,000 for as many years as he spent $110,000, all else being equal. In deleveragings, rather than debts rising relative to money as they do in upwaves, the reverse is true. As the money coming into debtors via incomes and borrowings is not enough to meet debtors' obligations, assets need to be sold and spending needs to be cut in order to raise cash. This leads asset values to fall, which reduces the value of collateral and in turn reduces incomes. Because of both lower collateral values and lower incomes, borrowers' creditworthiness is reduced, so they justifiably get less credit, and so it continues in a self-reinforcing manner. Dalio emphasizes that deleveragings are very different from recessions. Unlike in recessions, when cutting interest rates and creating more money can rectify this imbalance, in deleveragings, monetary policy is ineffective in creating credit. In other words, in recessions, when monetary policy is effective, the imbalance between the amount of money and the need for it to service debt can be rectified because interest rates can be cut enough to 1. Ease debt service burdens, 2. Stimulate economic activity because monthly debt service payments are high relative to incomes, and 3. Produce a positive wealth effect. However, in deleveragings, this can't happen. In deflationary depressions, deleveragings, monetary policy is typically ineffective in creating credit because interest rates hit 0% and can't be lowered further. So other, less effective ways of increasing money are followed. Credit growth is difficult to stimulate because borrowers remain over-indebted, making sensible lending impossible. In inflationary deleveragings, monetary policy is ineffective in creating credit because increased money growth goes into other currencies, and inflation hedge assets become investors' fear that their lending will be paid back with money of depreciated value. 3. Business cycle. The business cycle refers to fluctuations in economic activity. Dalio explains that, in the business cycle, the availability and cost of credit are driven by central bankers, while in the long wave cycle, the availability and cost of credit are driven by factors that are largely beyond central banks' control. In the standard business cycle, the central bank can boost a lagging economy by lowering interest rates. In the deleveraging phase of the long wave cycle, central banks can't exert any influence by lowering rates because rates are already at or near zero. It should now be clear why Dalio believes that any fundamental market analysis based solely on the entire post-World War II period in the United States is entirely inadequate. Although encompassing nearly 70 years, this period in the United States does not contain any deleveragings other than the current one that began in 2008. And, as explained, economies and markets behave very differently in deleveragings than in standard recessions. By focusing more broadly through both time and geography, Dalio is able to draw upon past instances that are comparable to the current situation, e.g. Great Depression, post-bubble Japan, Latin American defaults. In regard to the cycles that affect individual countries, Dalio takes an even broader perspective, measured in centuries, which he calls appropriately enough the really big picture. Dalio believes that all countries move through a 5-phase cycle. Stage 1. Countries are poor and think that they are poor. Stage 2. Countries are getting rich quickly, but still think they are poor. Stage 3. Countries are rich and think of themselves as rich. Stage 4. Countries become poorer and still think of themselves as rich. Stage 5. Countries go through deleveraging and relative decline, which they are slow to accept. This is how Dalio describes countries in Stage 4. This is the leveraging up phase, i.e., debts rise relative to incomes until they can't anymore. Because spending continues to be strong, they continue to appear rich, even though their balance sheets deteriorate. The reduced level of efficient investments in infrastructure, capital goods, and R&D slow their productivity gains. Their cities and infrastructures become older and less efficient than those in the 2 earlier stages. Their balance of payments positions deteriorate, reflecting their reduced competitiveness. They increasingly rely on their reputations rather than on their competitiveness to fund their deficits. They typically spend a lot of money on the military at this stage, sometimes very large amounts because of wars, in order to protect their global interests. Often, though not always, at the advanced stages of this phase, countries run twin deficits, i.e., both balance of payments and government deficits. In the last few years of this stage, frequently bubbles occur. These bubbles emerge because investors, businessmen, financial intermediaries, individuals, and policymakers tend to assume that the future will be like the past, so they bet heavily on the trends continuing. They mistakenly believe that investments that have gone up a lot are good rather than expensive, so they borrow money to buy them, which drives up their prices more and reinforces this bubble process. Bubbles burst when the income growth and investment returns inevitably fall short of the levels required to service these debts. The financial losses that result from the bubble bursting contribute to the country's economic decline, whether due to wars or bubbles or both. What typifies this stage is an accumulation of debt that can't be paid back in non-depreciated money, which leads to the next stage. And Stage 5. After bubbles burst and when deleveragings occur, private debt growth, private sector spending, asset values, and net worths decline in a self-reinforcing negative cycle. To compensate, government debt growth, government deficits, and central bank printing of money typically increase. In this way, their central banks and central governments cut real interest rates and increase nominal GDP growth so that it is comfortably above nominal interest rates in order to ease debt burdens. As a result of these low real interest rates, weak currencies, and poor economic conditions, their debt and equity assets are poor performing, and increasingly these countries have to compete with less expensive countries that are in the earlier stages of development. Their currencies depreciate, and they like it. As an extension of these economic and financial trends, countries in this stage see their power in the world decline. The foregoing Stage 4 and Stage 5 profiles sound like uncomfortably close descriptions of the United States, Stage 5, current situation. Stage 4, preceding decades, don't they? Chapter 3. Larry Benedict, Beyond Three Strikes. The road to success is often paved with failure. Larry Benedict did two things consistently during his early career: lose money in trading and get fired. The two often, but not always, related. Despite a complete lack of evidence that he possessed any trading skill, Benedict persisted in his quest to become a successful trader, somehow managing to find another trading job after each failure. Luckily for Benedict, there is no 3 strikes and you're out rule in pursuing a career. Ultimately, Benedict proved to be as consistent in success as he was in failure. Benedict's transition point came in 1989 when he was hired by Spear, Leeds, and Kellogg, SLK, to be an options specialist in the XMI index on the American Stock Exchange. As a specialist, Benedict gained some much-needed experience and developed a feel for the markets. When volume in the XMI started to dry up 3 years later, Benedict became an off-the-floor index derivatives trader for SLK. In 1993, Benedict's success as a trader led to his being named as the special limited partner for SLK's newly created proprietary trading department. After Goldman Sachs purchased SLK in 2000, Benedict left to start his own trading firm, Banyan Equity Management. A trading friend describes Benedict's skill in the market as follows: he has it. It's hard to describe it. Why does Ichiro Suzuki repeatedly hit 350? I don't know. Benedict is like Rain Man in that office, but get him out of the office and he can't even find his keys. In the office, he's like a friggin' maestro. Benedict is a very active short-term trader. He averages about 100 to 200 trades a day. Several years ago, the pace was even more frenetic, closer to 500 trades per day. His core market is the S&P 500. He also trades foreign equity indexes such as the DAX, Hang Seng, and Nikkei, domestic and foreign interest rate markets, major currencies, and key commodity markets such as crude oil and gold. The S&P 500 is the hub, and Benedict pays a lot of attention to how the other major markets are correlating, either directly or inversely, with the S&P 500. Benedict is essentially a mean reversion trader. That is, he will be a seller in short-term upswings and a buyer in short-term declines. The entry level of his trades will be determined by the prevailing volatility of the market, his directional bias, if any, and changes in correlations between the markets he trades. Benedict will also trade longs in one market versus shorts in a positively correlated market, or longs in an inversely correlated market, if he thinks the short-term price relationship is overextended. Benedict maintains the risk balance of a constantly changing portfolio, containing both directly and inversely correlated positions in his head. A former intern commented, "The things Benedict does mentally, other people need computers to do." Risk management dominates Benedict's approach. To say he is cautious is an understatement. If his losses in any month approach 2.5%, Benedict will liquidate the entire portfolio and start with a clean slate the next day, trading at a reduced position size. Typically, after a 2.0% to 2.5% decline, he will cut his unit size to 1/2 or less the normal level. Benedict will continue to trade at a smaller size until he starts making money again. The rapidity with which Benedict cuts his exposure explains why he has never had a large monthly loss. His worst month in 13 years of trading, 7 years in his fund and 6 years previously in a managed account and proprietary account, was a moderate 3.5% loss. David Horowitz, a former trader and the chief operating officer for Banyan, describes Benedict as follows: Larry is essentially a risk manager. It's not about making a lot of money. Of course, it's important to have return, but for Larry it's more important to not lose money. He knows that if he can manage the risk, he will make money. He understands when he is wrong and knows when he has to get out. Fundamental managers say, "I'm going to buy this stock for the next 6 months because I think this will happen." Technical managers say, "If the stock goes here, I will buy, and if it goes here, I will sell." Larry doesn't fit into either group. Larry has spent so much time in front of the screens watching these markets trade versus each other that he has a sense of when to buy and sell. Larry lets the market dictate to him what he should do, which is very different from how most managers approach trading. After joining Spear Leads in 1990, Benedict was net profitable for 20 consecutive years. The streak, however, ended in 2011, just barely, when his fund lost 0.6%. Since its inception in 2004, Benedict's fund has realized an average annualized compounded net return of 11.5%, 19.3% gross. If this return does not sound sufficiently impressive, keep in mind that it was achieved with an extremely low annualized volatility of 5.8%, and even more impressively, a maximum drawdown of less than 5%. Benedict's return/risk numbers are exemplary. His Sharpe ratio is very high at 1.5. The Sharpe ratio, however, understates Benedict's performance because this statistic does not distinguish between upside and downside volatility, and in Benedict's case, most of the limited volatility is on the upside. Benedict's gain-to-pain ratio is an extremely high 3.4. Benedict won't allow family or friends to invest in his fund, as one of his friends since childhood told me. Larry will never take any of investor money from friends or family. I tried to convince him to take money from me, but he wouldn't do it. When I was managing a multi-strategy fund of funds, he wouldn't even let the firm invest because I was the one directing the investment. He doesn't want to bear the responsibility. After 2008, when his parents had lost a lot of money in their conventional investments, just like most other investors, while his fund was up 14%, I asked him, "Larry, don't you now regret that you didn't let your parents and friends invest with you?" He answered, "No, that doesn't change anything. It would just add another layer of distraction. I would rather write my parents a check if they needed the money than ever have them in the fund." I visited Benedict at his offices in Boca Raton, Florida. Although there is ample space in their office complex, Benedict and his entire team are crowded together in a single room. Because of the confined quarters, and to avoid continuous distractions, we conducted the interview in an overly spacious but entirely unassuming conference room. Assistants would periodically come in to advise Benedict of market price moves and to get his trading instructions. I thought it odd that the conference room was about 5 times larger than might ever be needed, whereas the trading room was cramped. John Apperson, a managing director at Centennial Partners and an investor in Banyan, who had brought Benedict to my attention, explained this oddity in a phone conversation several months later. A number of years ago, when Banyan expanded their operation a bit with the growth of assets, they were all jammed together in that little room you saw. They decided to build out a new trading room in a larger space. The first day after they had relocated, Larry had a bad trading day. He said, "That's it, rip it out, we are moving back." What would appear to most of us as a much less comfortable work environment is not that way for Larry. Maybe he is more comfortable there because he can reach all his employees. Benedict is a happily transplanted New Yorker who lives in Florida with his wife Lisa and 3 sons. He loves the casual Florida lifestyle and dresses the part. Even though Benedict had institutional investors visiting his offices the day I interviewed him, he was wearing shorts and a t-shirt. Maybe they were his dress shorts. Although the room was surprisingly chilly, and I'm someone who likes air conditioning set to cold temperatures, Benedict, who was more appropriately dressed for a heat wave, seemed perfectly comfortable. Benedict was downright jovial in our conversation, but he was surprisingly candid about making me aware of the darker side of his temperament. In the course of our interview, Benedict enlisted several witnesses, both in person and by phone, to testify to his predilection to anger outbursts, a character trait I would not have guessed he had without his assistance. I later learned that his staff stocks ample inventories of phones, cell phones, and especially keyboards, items that are particularly vulnerable targets of Benedict's periodic temper flares. How would you describe your trading approach? I'm probably different from many of the other traders you'll interview. If you come into my office, you'll see that I don't look at charts at all during the trading day. I am just tape reading. And you don't use fundamentals either? I understand the fundamentals, but they don't come into play in my short-duration trading. You certainly are different. I have interviewed fundamental traders who don't look at charts, but you are definitely the first discretionary technical trader that I've interviewed who doesn't use charts. So right away we can say you are in a category of one. I sort of have the chart in my head. I look at prices and markets versus other markets. Our trade durations are very short, anywhere from a few seconds to a day or two. What markets are you trading? My main market is S&P futures, which I trade both on its own and versus other highly liquid futures markets such as the euro, yen, T-notes, gold, and crude oil. How did you get started in trading? When I was a senior at Syracuse University, I had absolutely no idea what I wanted to do. I was dating a girl whose father was a soybean trader on the Chicago Board of Trade. On one of my vacations, he took me to the trading floor. That was my first exposure to the futures markets. Did you know anything about futures? Zero. I didn't even know anybody who traded or was even in the business. What was your impression when you went on the floor? It was the most awesome thing I ever saw. I thought, this is what I gotta do. I loved that it was aggressive and competitive. When I was growing up, I played a lot of sports and I was ultra competitive. Did you try to get a job on the floor after you graduated? A friend of my aunt's family was a market maker in the floor of the CBOE and helped me get a job as a clerk. At the time, I thought $5,000 was a lot of money. The guy I was working for had $15 million in his account. And on my first day on the job, I remember walking a $1 million check over to Goldman Sachs. The clerk that I was replacing trained me for a day. He told me, listen, you're going to get fired every day. Just come back the next day. I'm 21 years old in a new city where I don't know anyone, and I'm being told that I will be fired every day. It was a bit unsettling. On the first day, I was thrown into the fire. I knew absolutely nothing. My boss was hand signaling me from the pit. I didn't know the hand signals yet. I had to learn them from a sheet they handed you. We got back to the office after the first day of work, and he says, my account is off by 20 lots. Get the hell out of my office and don't come back, you're fired. What did you do? I came back into the office the next morning, tail between my legs, and sat down at the desk. He didn't say anything, and he acted as if everything was normal. And then 2 days later, he says, you don't know what you're doing, you're fired. During those first few days, did you think maybe you didn't want to do this? It sounds like a miserable job. It was miserable. Did things get any better? No, it was definitely a bad period of time. He really needed an experienced clerk. After 6 months, we reached a mutual decision that I should leave. I took an easier job as a runner on the floor. After working for about a year as a runner, I got a trading position for a firm run by Steve Fawcett, that famous world adventurer. The deal was that you would put up $10,000 of your own money, and the firm supplemented it with $15,000. You kept all the profits on your own portion of the funds and 60% of the profits on the firm's capital. The firm supplied you with an exchange seat for which you paid a monthly rental fee. What had you learned that made you think you could make money as a trader? Not much. To be frank, I didn't have a handle on what to do. I was just making bets. I just thought I could do it. What's funny is that I remember calling my mom and saying, my friend Andy is making a fortune and I can't seem to make a dime. She said, oh, then just do what he does. What exchange were you trading on? I was originally on the CBOE trading options on stocks such as Chrysler and Revlon. Then they moved me over to the New York Stock Exchange to trade the index, the NYA, which is where I was at the time of the 1987 crash. In 1988, I went to the Amex to trade the XMI, the major market index, which is an index based on 20 of blue-chip stocks. Did you trade on the day of the crash? Yes, I came in short. Wow, that's great. No, I came in short straddles. I was short 20 calls and 20 puts. Oh my God, that drastically changes the picture. What was ironic about that day is that not only did the puts skyrocket as the market crashed, but the calls also went up because volatility exploded. So I was losing money on both sides of the trade. The account went from somewhere around $25,000 to a deficit in a matter of hours. I was frozen. I called Steve Fawcett to ask him what I should do. He said, stay on the bid, you'll get it. The market just kept falling, and I panicked and bought back my puts. I kept the calls. It didn't make sense to me that the calls should be way up when the Dow was down 500 points. I covered the calls a couple of days later. Where was the account when you covered the puts? It was probably in deficit around $10,000. This was not a big amount, but if you lose all your money, it doesn't make a difference if it's $20,000 or $1 million. I thought I was done. After I got out of my puts, I left the floor. I remember walking around Wall Street in a daze. There was a reporter from one of the local TV stations who asked me, "Can you give us a comment?" All I could say was, "This is unbelievable." That quote actually made it onto TV. Yes, I remember the day well. Even 2008 paled by comparison because in 1987, virtually the entire move happened in one day. One of my most important experiences was being on the floor on the day of the 1987 crash. Seeing that day taught me that anything can happen. How did it feel when you got out of the position? It felt good. I assume you would have lost more if you stayed with the position? A lot more. The put options went up so much by the end of the day that I probably would have been down several $100,000 if I had stayed with the position. They crushed the market on the close, and the volatility went insane. The puts that I covered at 20 probably went as high as 200. Since you had taken the account into a deficit, you obviously couldn't trade. What happened next? The firm had a standard policy of replenishing traders' accounts with $25,000 if you blew through the first $25,000. You would become a prop trader for the firm. It seems like an odd structure. What was the logic of the firm giving traders additional money after they lost the initial stake? They felt that there was a good probability you would chew through the initial capital, which was partly your own money because of the learning curve. They figured you would have a better chance once you had the experience. Also, they were earning commissions off your trades, so if you just broke even, they would do quite well. It was in their interest to try to keep you trading. How did you do with the second $25,000? I floundered and had gone through part of that capital as well when a friend of mine, who was a market maker, approached me with an offer to trade a $50,000 prop account for him and another guy. The deal was that they would allow me to lose $30,000 before pulling the plug on the account. I wasn't doing well with the Fawcett account, so I made the switch. Since you hadn't made any money, on what basis was he offering you the account? He saw me trade in the pit, and I guess he thought I could make money. I don't know why he thought that, but he did. I also think he wanted to give me a shot. What happened was that after I'd been trading the account for about 1 month, I lost $16,000. I called him that night to let him know about the loss I'd taken. It was the most difficult call I ever had to make because he was a friend of mine and he had given me an opportunity. He told me to take some time off to clear my head. After I came back, though, he told me they had decided to terminate the account. I have to ask you this. You got fired from your first job. Then you got a trading job and blew through the money. They gave you more money and you blew through most of that. Then a friend gave you a stake and you lost money so quickly that he pulled the plug before you reached your cutoff point. As I am reciting this litany, Benedict's laughter builds steadily. Didn't you at some point say to yourself, maybe I'm not cut out to be a trader? No, I never gave up. I know you never gave up, but not to be cruel, on what basis did you have any confidence? I just wanted to learn how to do it and win. I saw all these other guys making money, and I thought if they could do it, I could do it. But up to this point, I had no strategy and no discipline. I was, however, gaining experience. All the mistakes I was making along the way, and there were many, were providing experience which was critical. The lessons I learned from those early failures helped me become successful. What did you do next? The pit was like a fraternity. One of the other traders in the pit who worked for Spear Leads offered me a job as a specialist. I was a specialist for the XMI calls. I owe a lot of my success to Spear Leads. They gave me stability. Larry Lavecchio, who I worked for at Spear Leads, taught me discipline. I watched how he traded, the risk he took, and how he protected the capital. Were you just making the market in the XMI calls, or were you also trading a proprietary account? Both. As the specialist, you provide liquidity. You also have an inherent advantage in trading because you see the order book. When you fill an order, how do you lay off the risk? If I was a seller of calls, I would buy futures against it. I would keep the book close to delta neutral. So you were essentially making the bid-ask spread and laying off the risk. Yes, but as a specialist, you also have to anticipate. If the market is strong and you know you will have call buyers all day, you buy futures ahead of that. In other words, you anticipate your hedge needs and adjust your delta. That process was part of developing a feel for the market, which I never had in all those years of just knocking around. How did you develop that feel? I started paying attention to the intermarket price relationships. For example, if the S&P was moving in an inverse lockstep to the bonds, and bonds were down for the day, but the S&P
is annoying. 30 minutes spent while hungry and exhausted, with no reward to his business, would just be too much for Steve. So he convinces himself that he loves everyone. I'd take his recommendations in this context. G-Man liked him, but wasn't blown away. Steve had it right, if you do not discount the fact that he loves everyone. If I had known Moneymaker would work so hard, and that he had exceptional trading talent, I would have graded him differently. Today, I pray for candidates like Moneymaker. One of Steve's roles in the interview process is to ask candidates questions that test their mental acuity. In our business, 5 seconds can be eternity, so the ability to process information quickly and react appropriately is crucial. In his book, Liar's Poker, Michael Lewis writes of a big bank's recruiting technique where a candidate is instructed to crack a window that cannot be opened. This is a test of how a candidate will react under pressure. We do not go to these extremes, but we do search for evidence. My favorite of Steve's questions is, try to answer in 5 seconds. You have 16 socks in a bag. 8 are white and 8 are black. How many socks must you remove from the bag to be statistically certain that you will be holding a pair in your hand? Not every candidate can do this well, even those who look good on paper. Some stumble. They're so nervous for the interview that they either outthink themselves or answer so quickly and cockily to mask their nervousness. For those who can handle tough questions in tough spots, they show an implicit passion for the markets in doing so. By the way, the answer is 2. Not to draw on another extended sports metaphor, but Moneyball is one of my favorite books. It shares how the Oakland A's, or more accurately Billy Beane, Oakland's general manager, discovered inefficiencies in Major League Baseball. For example, Beane recognized that batting average was not as important as on-base percentage. Similarly, Tom Verducci, in The Yankee Years, shares how the Cleveland Indians have developed a proprietary database to find new inefficiencies. What is important is that some baseball teams were not using new statistical data to find players who would fit into their system. I think about Moneyball a lot as a partner at SMB. We need to find those who are best for our specific style of trading. At our company's inception, we were awful at finding these people. So one day, G-Man, Steve, and I started working on improving our methods for identifying good candidates. Like Beane in Moneyball, who developed algorithms to find players who fit Oakland's criteria and, much less than the Yankees' budget, we created a recruiting matrix of our own. We identified specific characteristics of candidates that are most important for how we trade, and assign them numerical values. Once the interview process is ended, we gather all the data from our matrix and use it to compile more objective criteria with which to make hiring decisions. We used to recruit like old-school scouts. We would evaluate based upon what candidates said and their body language. One of my favorite lines from Moneyball is when Billy Beane dismisses comments from an old-school scout who advised to pass on future Boston Red Sox slugger Kevin Youkilis because he does not have a good body for the game. Beane retorted that the team was not selling designer jeans. Similarly, we are not trying to find people who look and sound like they will be good traders. There are some firms who believe you really just cannot tell who will be great until the training begins. So they bring in a class of trainees, and in Darwinian fashion, the strong survive. If you do not show promise early, then you will be cut. As long as firms are upfront about this process, this is certainly fair. Outlier number 1. Psycho. As important as it is for a prop firm to develop an effective recruiting matrix, and as advanced as our methods have become, we will still miss some traders. Some will be outliers, lacking the most important of personal characteristics, like the ability to control your emotions, process information quickly, or fit into a firm's culture. Not every good trader I have met or developed meets the general characteristics of a CPT. For example, one of the best traders I know is probably certifiably insane. One of the criteria used in most prop firms' recruiting matrix is a calm disposition. For the first 2 years at SMB, I slept about 4 hours a night. Some days I would just rise and head to the office in pre-dawn hours. There were videos to produce and lectures to write, and it was calming to me to just be getting work done instead of lying in bed fretting. So one day I headed into work around 6 a.m. As soon as I got off the elevator and tagged my security badge to enter the trading floor, I stopped quickly like a driver who just spotted a deer. Someone was screaming at the top of his lungs. I couldn't hear what he was saying, so I just stood there frozen, unsure what to do. I did not want to walk in on someone who was arguing with a girlfriend, but I also didn't want to walk in on someone who might shoot me. So I stood there for a few more minutes. The trader screamed at the top of his lungs, "You're the reason I'm in this situation. I cannot believe you did this to me." I recognized his voice. Not only was he a trader on our floor, but he was the best trader on our floor. He wasn't mad. He was emotionally unstable. Think Christian Bale's character in American Psycho, or Christian Bale as himself on the set of Terminator Salvation. I have never heard someone that distraught in my life. I took the elevator back down to the street, emailed someone to check out the disturbance, headed over to Starbucks, ordered a green tea, read the New York Post, and waited. I wrote a new lecture, packed up, and headed upstairs. Psycho was staring at his screens and grinding out profits. He was up over $10,000 before 8:15 a.m. And that was just chump change. Hardly a huge day for him. So much for needing to be calm and emotionally stable to be a good trader. Psycho is an outlier. Outlier number 2. Tebow. One of my favorite people of all time had to beg his way into the prop firm where I started. Tebow, Tim Tebow, the Heisman Trophy-winning All-American quarterback for the University of Florida, reminds me of this former trader. Had gone to a mediocre state college, played on their football team, and could not get an interview there through the conventional channels. In fact, he probably couldn't have gotten an interview anywhere. I think it is fair to say that Tebow would not impress an interviewer with his ability to process information quickly. Some hedge funds and other prop firms administer mental math tests as part of their weed-out criteria. Should he have had to take one of these tests, he would probably have been asked to leave the interview within a minute or two. You know what? Let's let Tebow tell his story. Finding a job was a bit of a struggle for me. I had a good GPA, 3.4 overall, 3.6 in my major, finance, and 3.8 in my minor, economics, from TCNJ, Trenton State. I had put in for a few jobs, but I didn't get a call from Goldman or Merrill and was a bit discouraged. I knew that I wanted to work with stocks. I did receive interviews from Thomson Financial and some financial planning place, both of whom seemed very interested. However, that was not what I wanted to do. An upstart trading firm granted me an interview in the fall of 1997. They sent this well-dressed Italian guy named Dominic with a last name that started with a D. I will remember it later. We sat in a room on my campus, and he began to tell me about my dream job. He liked that I was a college football player and that I had good grades. He said that a good trader could make at least $100,000 their first year. That was all I needed to hear. Weeks and then months went by, and I heard nothing. Maybe this company wasn't really interested. Over 2 months later, I received a phone call setting up my long-awaited meeting with the firm's managing partner in New York City. I got all dressed up in my one and only suit. I even bought a pair of Rockports that set me back 150 beans, threw on my red power tie, and was ready to meet Wall Street's elite. What I got was not what I expected. The traders weren't dressed like me. They were in jeans and T-shirts. This couldn't really be Wall Street, could it? Then I met the managing partner. He was dressed in jeans and a collared shirt. He took me into his office and we started to chat. The one thing I can remember vividly about the interview was that he asked me what else I would want to do if I couldn't be a trader. I answered that I would want to be a pro athlete, football player specifically. The interview was short, 15 minutes or so, but enjoyable. I knew that I would enjoy working for this firm if I was offered the job. The good news is that I didn't have to wait 2 months this time. They offered me the job within a week and told me that it was contingent upon passing a Series 7 exam. I graduated in May, would take the test July 6, 1998, and start July 20th if I passed the test. I did pass, but barely. I celebrated like any New Yorker would by buying a 22-ounce Heineken and drinking it in the street with the bag still on while walking down the sidewalk. Beer never tasted so good. I was going to be rich. When Thibault first started, he was moved to sit next to one of the firm's great traders to try to improve by osmosis. But he was struggling hard. You didn't get fired back in the day, but if you struggled enough, you would get your draw cut. Often a draw cut would prompt a resignation, and a draw cut was imminent. He had 1 foot out the door. Despite the dire circumstances, he would not let anyone outwork him. He kept at it. Slowly he got a little better, and a little better, and a little better. Then the market improved and offered more opportunities. Today this trader is retired, paid for his house in full, and teaches and coaches in one of the nicest areas in New Jersey. Thibault was an outlier, but he did it. Outlier number 3. Tickster. For a training class, we hired a trader who demonstrated a passion for the markets and exceptional intelligence, with an SAT math score of 800 to boot. Tickster, named for his superior ability to read the ticks in a stock, had traded somewhere else, but was not happy with the training offered. He was a little quirky. Later I would learn he subsisted on Burger King and candy. He had trouble keeping still during his interview. Tickster would answer my question before I finished it. He did not exhibit the calm demeanor essential to be a CPT, but we gave him a chance. During the first week of the training class, 2 separate traders from our firm asked to talk with Steve in private. They relayed that this new trader had been complaining about his payout structure. It was the first week. Apparently, he was bad-mouthing his deal to the others in his class. His strong show of nerve continued on his 3rd day, when he plopped himself at the table of our more experienced traders while eating lunch and cut them off repeatedly. Most newbies are like freshmen on a college team. They do not sit with the seniors until asked, and that is certainly not on the 3rd day. These 2 traders made it clear in no uncertain terms that they did not want someone in the firm like this. Steve asked to speak to this new trader privately. He shared what he had learned. Now let me explain the dynamic at SMB. I do most of the teaching and coaching. I'm really hard on our guys early so they learn the standard that I expect from them, or more accurately, the standard that the market will expect of them. And also, behind closed doors, I am the one between Steve and me to react viscerally. And Steve knew that when I learned of this, my response would be something like, "Get him the hell off our trading floor." This new trader apologized and apologized, and, as Steve explained, was sincerely sorry. But Steve ended the discussion with, "I sincerely doubt that Bella will have any interest in training you going forward." And then Steve called me. He instructed me to sit down and told me the story. What was my response? "Get him the hell off our trading floor." At our firm, we give you every resource to succeed. We will eat six-figure losses if necessary to help a trader become a CPT. But we only work with those who highly value what we offer. And this new trader did not value what we were offering and was infecting his new class with negativity, hence my reaction. Over the weekend, Tickster sent us a long, contrite email. After reading it, it occurred to me that he was young, perhaps socially undeveloped, and may just have been running his mouth without malice. I told him to show up on Monday, work hard, and we would forget the whole thing. It is possible that I had a bottle of Pinot Noir in me when I wrote this email, heightening my compassion. But that is off the record. Anyway, that was my decision. It is not fair to cut a new trader based upon one transgression, and when you give them another shot, it breeds loyalty in some traders. Fortunately, I gave Tickster another chance. What was the result? This individual has been nothing but hard-working, helpful, and positive. He has worked on his game every day. Tickster picks up others when they are down. And he has come into his own as a solid trader. Recently, he was recognized as our most improved trader. You could not ask for anything more from a trainee than what he is given. He was an outlier, and we were lucky. The pros and cons of recruiting experienced traders. Landing an experienced trader at your prop firm can be a huge win. But too often, prop firms undermine their culture for increased profits. We have learned from this mistake. Often those who claim to be experienced professional traders are failed traders grasping for another chance. It is all about finding an experienced trader who values what a firm offers and who is a good fit for the prop firm. We receive inquiries from experienced traders regularly. We will not recruit a profitable, experienced trader unless they have already left their firm. We do not poach. Wall Street is saturated with legendary stories of poaching. Headhunters make a living on this very practice. Conventional wisdom says, get a new job while you still have your old one. But our line of work is hardly conventional. We believe it is not fair to the firm that developed this trader, took the risk on him or her, and has spent so much time and energy working with him or her. That firm deserves the rewards of their work. The reality is, though, that sometimes traders need a new place. They just do. Before I started SMB, I had to leave a firm, and I landed in a better place because I did. Many years ago, I traded at a firm that had recently relocated. At this new location, our trading platform went down almost daily at 9:35 a.m. for extended periods of time and into the close. The platform failed whenever the volume spiked. So I voiced my concerns to the firm. They assured me these technical problems would be fixed, and I know they tried very hard. However, the new building handicapped their ability to make infrastructural changes, and they just couldn't get the problems fixed expeditiously. Like any rational trader, I had to leave. I hadn't been able to do my job for months, and the problems were not going to be fixed soon. I couldn't afford to sacrifice more months of lost profits because of the supposed simplicity of back-end infrastructure. In all honesty, I felt awful about leaving. This is where I got started, and they deserved my loyalty. Loyalty is a good thing to a point, but it cannot trump logistics and reality. So, while every now and then traders need a new home, and I know this all too well, we at SMB have found it difficult to integrate some experienced traders into our firm. Our style is a specific one whose philosophy may not be shared by others, but we have done it. When we first started, we found a trader who needed a new home. The first day he sat down, he made more money than anyone on our desk. But he fought off a lot of what we did and taught. He made money, and at the time it was still worth it for us to look the other way when he refused to act in his self-interest. He was uncoachable, and there came a time when he needed guidance. Today he sells insurance in central New Jersey. The house, a different definition of consistently profitable. While new experienced trading blood can be welcome, It can also come with headaches and nuisances we wish to keep off our desk. We once hired an experienced trader named The House, but his nickname had nothing to do with his looking for a new home. He was The House because he could have very well been the world's largest trader. Famous hedge fund manager Larry Robbins has earned the nickname L-Train for his size, but even he isn't as big as The House. The House was more likely to play in the NFL at his prodigious 6'3", 350 pounds. The House had had a disagreement with his last firm. Often the party line in trading when leaving somewhere, whether justified or not. But he was willing to buy into our system, and we liked that. While some firms welcome varying styles, we mostly prefer everyone to be on the same page. However, once the House started trading, he redefined consistently profitable. He lost money for 30 days in a row. I suppose I can give him credit for being consistent. Just to offer some point of reference, on average, I lose money on 10% of my trading days. Sometimes I go 30 days without having a negative day. But losing money 30 consecutive trading days is not a slump. It's an infectious disease. Along the way, I asked him if anything had been bothering him. He said no. What made it worse was that he was not particularly bothered by this losing streak. The legendary trader Paul Tudor Jones said it best: losing money should really bother you. If I am negative 3 days in a row, I spend a long evening on my couch with a bottle of red wine and comfort food. This guy was weighing down his ship in more ways than one, sinking further into the abyss. As traders, we can all recite the memorable line from Wall Street: "A man looks in the abyss, there is nothing staring back at him. At that moment he discovers his character. That keeps the man out of the abyss." I appreciate that trading can be tough at times. However, our new traders were all making money during this period, and it was clear what the real disagreement had been at his old firm. We let him go. Billy Bucks. Good trader, bad fit. While a consistent money loser like the House is unwelcome on any desk, some firms are willing to sacrifice professional culture for the bottom line. We are not one of them. Take Billy Bucks, for example. When he walked in to start with us, we read him the riot act about fitting into our culture. He said that he understood and would buy into our way of doing things. Unlike the House, Billy Bucks could trade. He made money pretty much every day, demonstrating the skills of a seasoned pro. But Billy Bucks would show up in game jerseys, as if every trading day were a game day at Giants Stadium. T-shirts are one thing, but game jerseys are unprofessional in the intraday trading community. They are to be reserved for weekend warrior activities, followed by drinking games. Billy Bucks did not get this memo. But what compounded his unprofessional dress were his late arrivals. He was part of the non-professional day trading culture from the 1990s, when you came and left as you pleased. One day he arrived at 9:35 a.m., sat down, and asked G-Man what he was trading. G-Man responded, "STFU, I am trading. Why don't you try showing up on time?" We are a professional desk that works hard, shows up early, prepares with a sense of urgency, and relies on each other. And Billy Bucks was just not one of us. Refusing to join the League of Lesser Firms. We ended up hiring a semi-experienced trader who was very talented but lacked discipline. We will call him Ungrateful, or UG. To remedy the problem, Steve took UG under his wing for 3 months. For 2 of those months, he talked UG through every one of his trades. "Be careful, the stock may reverse," cautioned Steve. "Do not be so aggressive here. The stock could go either direction," Steve would bark. UG ended up making $15,000 one month and over $20,000 the next. Previously, he had been nothing but negative. Now, to talk through every trade with another trader means sacrificing a great deal of your own P&L. During the open and close of every day, I talk through my trades with our new traders via our audio feed. I explain why I am buying, why I am selling, and what I am thinking. I talk with more detail when a new class begins. As such, my P&L suffers with the start of every new class, sometimes up to 50%. When the class is over, my results immediately improve. But still, every morning I try to trade easier stocks so that my commentary over our training call is most useful for teaching. And this is what Steve did for UG. So now here is Steve, who has sacrificed the last 3 months of a great portion of his trading for UG. Another firm had learned of UG's recent success and started poaching him. They eventually persuaded him to switch, promising a better deal structure. Look, I do not want to hold anyone back, but switching to this other firm was not in UG's best interests. Steve had carried him. UG was not ready to trade without attentive mentorship. And since Steve is one of the better traders I know, and certainly one of the best teachers in our space, it was doubtful this trader would be better in a new home. I had a choice. I could have wished UG the best of luck, or I could have told him the truth. I opted for the latter. I told UG that Steve carried his P&L for months. I told UG that he was very talented. I told UG that switching was not in his best interest. I told UG there was no chance he would succeed at this other firm. In fact, I said, if you go to another firm without the direction from Steve, you will with 100% certainty blow up your account within a month. Even after all that, I failed to persuade UG to stay. Next, I called up the partner at the poaching firm and explained the situation. Call him Harpoon, the weapon of whale poachers. Harpoon replied that he was sorry that some of those under him approached UG without his consent, and he had just found out about the situation. I was waiting for the moment for Harpoon to tell me that he was so disgusted with the practices of his rank and file, and that he would revoke the offer to UG. He just said he was sorry how this all came down, and that there was nothing he could do about it. I was embarrassed for that other firm. Nothing you could do? You're the managing partner of the firm. How about after you found out your guys were poaching a trader, you tell them to stop? How about you refuse to join the League of Lesser Firms? One of my favorite TV shows of all time is The West Wing, written by Aaron Sorkin. One of my favorite episodes finds President Bartlet making a life-or-death decision over how to deal with an international terrorist. President Bartlet has been advised to assassinate this terrorist before he endangers the U.S. But there are international rules on how we can assassinate a terrorist, and a plan is devised that technically does not breach international law. President Bartlet is debating with his chief of staff about a go-ahead and offers this objection. Doesn't this mean we join the League of Lesser Nations? To me, poaching, while it can be financially rewarding, is joining the League of Lesser Firms. Harpoon could learn from the classy Andy Kirshner, CEO of Kirshner Trading Group, a firm 3 times the size of Harpoon's, who personally called me to ask my permission to talk to a former SMB trader who had already left our firm and the East Coast. There is an unwritten rule amongst friendly prop traders to advise every experienced trader to first talk to their firm and work things out. It takes a great deal of hard work to develop or find an experienced and consistently profitable trader. Most prop firms will only talk to traders who have already left their firm. Once we take this shortcut to success, we will rationalize others. I am not joining the League of Lesser Firms. Anyway, UG left for this other firm. The result? Unfortunately, I heard that 2 weeks later, UG blew up his trading account. Z-Money, the gold standard. While the House and Billy Bucks are extreme examples of transplants gone awry, I love stories like Z-Money. At his last desk, he was sitting around a bunch of traders who could not adjust to the new hybrid system for NYSE stocks, a mix of traditional market making by specialists and human-free machine trading. Being in the wrong environment without strong support around him, Z-Money was not making money. We talked about our culture, and he claimed he could fit in. So Z-Money went through our training program. We showed him how to read the tape with the hybrid system, find stocks in play, and compete in this different market. Z-Money started slowly, but eventually he started making money. Steve pushed him harder to be more aggressive, as Z-Money had a tendency only to wait for certain setups. The pushing apparently worked, as Z-Money's trading profits increased 300%. This new home with us was a great fit for him. This is another one of the guys that we work with that just brings an immediate smile to my face. You can't hope to work with a nicer person. There are low-maintenance traders, and then there is Z-Money, who is non-maintenance. Z-Money speaks so softly that, like megafund manager John Paulson in front of Congress, we often have to ask him to speak up. He has become one of our core guys, even if we can't understand him half the time. If you are an experienced trader looking to switch firms, it is important that you consider the culture of the new firm first. And as a firm, you must consider whether a new trader would fit in. It is not enough that a trader is consistently profitable. He must also be a good fit. If not, he will tear away the culture of your firm. And this is a loss. And that loss is often more than the income this trader is producing. A good fit for the trader. Hopefully, so far we have offered an inside view of what a proprietary firm seeks, at least one example anyway. Not everyone has a choice between firms, but for those who do, take the following into account when making a decision. Training is most important. The two types of training available for new traders are what I call, quite plainly, old school and new school. Old school training consists of a new trader sitting next to a mentor for a few weeks. There are no classroom training sessions or daily take-home assignments. Just watching and learning while trading a demo alongside your mentor. This is how I started, and at the time, the late 1990s, it worked just fine. My mentor, after all, was considered one of the greatest day traders of all time. In our world, he was a superstar, as if I was getting personal lessons from Tiger Woods on hitting a stinger, his famous low-flying tee shot, or Michael Jordan on how to take it strong to the hole. The problem was, he was too good. He would have 5 different open positions with 10K plus shares on each. Meanwhile, I didn't know a bid from an offer. How was I supposed to follow 5 different positions? But things were different back then. First, the market was not as complicated, as programmed algorithmic trading had not become a common practice just yet. Plus, the market was more directional. Second, this was the best training that could be offered, considering technological limitations. Third, there was no competition back in the day. We were one of only a handful of firms day trading. Today, some firms have carved out a competitive edge through their training. So for that time period, I was fortunate to receive the best training available. But today, we can train new traders better because of enhanced technology, online interactive platforms, more reams of data available, and better access to psychological support. Proper training now includes mentorship, classroom instruction, access to a trading simulator, videos that explain trading setups, hundreds of written lectures, an audio call where in real time you can hear what senior traders are trading and why. Without giving away the recipe for the secret sauce, that's essentially what we do. Oh no. Why talking yourself into a firm is not in your self-interest. Take the example of a gentleman we recently had to fire. We'll call him Oh No. This ambitious, bright young man was a broker who wanted to trade. I don't blame him. Cold calling 400 strangers a day to sell some dogshit stock is no fun. Oh No initially sent us his resume and HR rejected him. He mailed in his resume. I passed the resume to HR, who again rejected him. Not to be deterred, Oh No showed up at our office one day, charmed HR, and gave them his resume. HR asked me if I would speak to him. I replied, "What is this, Denny's? There are no interviews without an appointment." But Oh No was relentless. He even befriended one of our traders, and when that trader came to speak to me about letting him at least interview, I reluctantly agreed. After 5 minutes, it was clear that he just was not cut out to be a trader. At one point, I actually told him this. But again, he kept pushing forward, not taking no for an answer. He talked about how hard he works as a broker and how hard he will work for us, all in a very likable way. His slick-talking broker skills were coming in handy. He fooled a few others on the desk before the interview as well. I, too, wanted to believe in this young man, and I convinced myself that we could make him into a good trader. Perhaps he was an outlier I spoke about earlier. At the time, I had been reading Nassim Taleb's book, The Black Swan. Maybe I did not have enough information to conclude he was not really cut out to be a trader. I decided to give him a shot. But when Oh No showed up for training, my initial reservations were vindicated. One morning, he showed up late. A week later, I asked him to answer a simple question during a classroom lecture, and he was lost. Once we started trading, his results were consistently poor. At one point, I caught him playing internet games at 10:15 a.m., our peak trading time. But Oh No was staying late every night. Unfortunately, the staying late was all for show. He wasn't doing any work, just flipping back and forth between screens, making it appear as if he was working hard. One of our senior traders also told me Oh No would be off the desk for long periods during the day. This was my fault. I overbelieved in my outlier theory. Oh No's past history told me all what I needed to know about him, and it just continued during his training and subsequent live trading. He lost the firm a lot of money, hurt the morale of his classmates, and senior traders resented having to mentor him. We had to let him go. In the end, it was not in this young man's self-interest to talk himself into our firm. He made no money and could have been learning a skill that was better suited for his talents. He is obviously very talented, likable, and bright, and he will be successful one day. But he wasted 6 months of his life on my time. What good did that do him? Funny postscript. Oh No recently reached out to HR to ask if he could have another shot. A Good Home. Alexander Elder, in his book Trading for a Living, writes about the danger of the cost of trading to the developing trader. Dr. Elder theorizes that trading is not a zero-sum game, but rather a minus-sum game. Your parent firm housing you as a trader may make money on commissions, yet you may not make a dime. You want to avoid a situation where your payout scenario makes it impossible for you to make money. Most prop firms charge you for your trades and then split a percentage of your profits. At SMB, new traders trade at close to our cost, which is very low, and we split their profits. If you are going to be charged more than $8 per 1,000 shares and then split your profits, it will be difficult for you to make money if your firm advocates a high-volume trading style. It is important to find a firm that is ethical and patient with its new traders. New traders don't often take this into account, searching mostly for the highest payout. It is likely that at one point in your career you will need a negative balance erased, or that you need some help financially, perhaps an advance or draw. Recently, a veteran SMB trader needed an advance and started to explain why. I cut him off. The check will be on your desk by the end of the day. It is probable that you will need a firm that believes in you, though you are not yet a CPT. A good prop firm will help you, if not take care of you before you become profitable. They will treat you fairly and not just look at what you are presently producing. They will reward your hard work and contribution to the firm. And if you're curious about what you can do, or what you can say, or what you should wear, or place on your resume to land a spot on a prop desk, then I have this advice. Be yourself. Prop firms know who they are looking for and where to find you. Let them do their job. But if trading is your passion, Then open up a trading account as soon as possible, start trading small, and put that on your resume. Scour the internet for trading blogs of most interest to you, and plaster that on your resume. Read books about trading and smack them on your resume. When you interview, highlight specific trades that you have made recently. In short, demonstrate your passion for the markets. Traders don't talk about how they want to trade, what they want to read about trading, or how they wish they could talk about trading. Traders trade, read about trading, and talk about trading. Visit a bunch of firms before you decide who may be the best fit for you. Meet their traders. Question them about their experience at the firm. Ask if you can sit in on their teaching, as this is of utmost importance. Talk to the partners or whoever runs the firm, and make your own decision on who offers the most value to you. Okay, so after you land your dream job at a prop firm, what things are truly important to focus on to become consistently profitable? Let's go build a pyramid of success together. Part 2. Tools of Success. Chapter 4. Pyramid of Success. It is day 1 at 11:30 a.m. for a new training class at a prop firm in Lower Manhattan. A team captain leads his fellow trainees into a training room lined with seats stacked closely together to maximize space, plastered with neutral beige paint colors, a plant in the back of the room that can never die, and a $4,000 supercomputer which is linked to a gorgeous 65-inch flat-screen TV hanging from the wall at the head of the room. On the screen is an empty pyramid. A prop firm leader enters the room, dressed in jeans, Dallas Maverick Adidas sneakers, and a striped Paul Stewart dress shirt with its sleeves rolled up like a politician on the campaign trail. All conversations end. These new traders affix their eyes on a tall, knocking on the door of 40, experienced market veteran some have traveled from as far as India to learn from. This is their first lecture. In a comforting and compelling voice, this prop trainer pauses at certain moments, lets the silence linger, and then accentuates a point not to be forgotten. He starts, "What is important for you," pause here, and now the accentuation, "to succeed as a prop trader? Work together as a group to fill in this blank pyramid, and then come find me so we can discuss what really is important. This is the best job in the world, but only for those who do all the things necessary to succeed. Okay? Good luck." So you start trading at a prop desk. This is your dream job. Failing is not an option. There are literally thousands of trading books you could purchase with helpful hints. The internet is flooded with educational trading blogs. Bloomberg, CNBC, and Fox offer endless hours of pros pontificating their opinions. And there is the Wall Street Journal and IBD and the Financial Times. And then there is Business Week, Fortune, The Economist, and SFO, and on and on. What is important? With all this information, what do I watch? What should I focus on to reach my trading potential? I know of many new and developing traders overwhelmed with information and empty with ideas to improve. Certainly, I have witnessed too many prop traders start their careers focusing on all the things that have nothing to do with making money. One common question that I am asked during an interview is, who is the worst trainee? My answer? Anyone who thinks they know what they are doing. I do not mean to be condescending with this remark, but as a developing trader, it is imperative that you work on the right things. You must focus on the process and learn how to trade from those who have been doing this a lot longer than you have. Preconceived notions about what is important before you trade professionally can be harmful. So this pyramid of success exercise is offered to make sure that everyone is focused on what is truly important. If these traders indeed do focus on what is important, in time they will find out how good they can be. If they take another path, the market will eliminate them with no exceptions. But first, take a stab at filling in the pyramid of success. If you were in that room with all those ambitious, passionate new traders attempting frantically to fill out that blank pyramid, What would you offer as answers to what is truly important to succeed as an intraday trader? Once you've done that, listen to this chapter for a discussion of what is really important to the intraday trader. Good luck. First, be unoriginal. Often, new traders mistakenly believe that trading is about developing some brilliant new strategy or making bold predictions. At some point, I have to remind them that at 22 years old, they are not yet a market guru. They are not Jim Rogers or Warren Buffett or John Paulson. Perhaps one day they will be stars like these guys, in which case I might demand a cut of their billions. But for now, they should come in with an open mind. My sense is that this falsehood is propagated by the new traders' misinterpretation of what they learn to be important from the media. If we are not sure, blame the media, right? Every day, experts go on CNBC or Bloomberg News and propagate grand theories, more often than not talking their book. Some are legitimate. Some got placed there by good publicists. Please do not mistake what they do with what most meat and potatoes intraday traders do. We do not make grandiose predictions on the direction of the U.S. economy. We do not have billions we must invest like hedge fund and mutual fund managers. We are not long-term investors. Successful prop firms first and foremost emphasize trading skill development. Simply put, you do not have to develop a brilliant new trading strategy, as we teach you proven ones. So before you start calling yourself a market wizard, learn how to trade. When you gain experience, after you have developed good habits and skills, you will be able to create new plays that work for you. But not at the beginning. My advice to any new traders is to seek a mentor who will offer you trading skills that will allow you to adapt to any market. Learn more in Chapter 12. What works one month may not work the next, but with fully developed trading skills, you can make the necessary adjustments. Let me offer an example. No longer hitting the new low. In the fall of 2008, hitting the new intraday low in a stock would work in the financials. See figures 4.1 and 4.2 on your bonus material, which were bleeding daily. By hitting the new intraday low, I mean getting short a stock in an intraday downtrend when it makes a fresh intraday low for the day. There was a run on some, if not all, of the banks. Of the big banks left, the market kept asking who would be next. During the fall of 2008, sometimes I felt the only bad trade I could make was to cover a short. Before I talk about when this strategy started to fail with GS, it is imperative I give context to what we're dealing with. It was one of the best times in history to trade our intraday style, as stock prices of financial institutions were moving like the dot-coms of yesteryear, just in the other direction. In March 2008, Bear Stearns, a firm with an 80-plus year history of never losing money, needed to be rescued and was sold to J.P. Morgan at a deep discount with support from the Federal Reserve. 6 months later, a flurry of activity ensued. The U.S. government nationalized mortgage giants Fannie Mae and Freddie Mac. The mighty Merrill Lynch was acquired by Bank of America, an ego blow to thousands of brokers not used to handing out toasters to new clients. And of course, who could forget Lehman Brothers? Lehman was a firm known for recruiting some of the best finance talent in the world, and in the absence of government support, filed for bankruptcy, prompting a falling-off-the-cliff moment for the global economy. Hallowed names in the financial industry were being eliminated one by one, seemingly day after day. But wait, there was even more. The Federal Reserve bailed out AIG, the largest insurance company in the world, the day after Lehman went under. Morgan Stanley and Goldman Sachs, the two whitest shoe names in the investment banking world, would soon join their Merrill peers in handing out toasters as they incorporated to bank holding companies. These Wall Street icons would now be subject to more intense regulation as depository institutions. Washington Mutual, a thrift that had grown by leaps and bounds in recent years, was seized by the FDIC, creating the largest bank failure ever. PNC Bank soon bought Ohio-based stalwart National City, and California megabank Wells Fargo bought fast-sinking Wachovia. With Wall Street and Main Street simultaneously collapsing, SMB must have gone out of business, right? No. Mike, you blew up your trading account? Nope. This was the best intraday trading time period since 1999. And let me say that I hated every day during this crisis, even with the outsized trading profits. Your job as a trader is to exploit excellent risk-reward opportunities, but this is not how I want to make money. Good people lost jobs that will never return. Historic firms were just destroyed in a blink of an eye. On my desk, I wondered if it was possible for our entire banking system to go down. Was the money in my bank account safe? Did I need to withdraw it all and put it in a safe in my apartment? Would all of these trades I was making eventually clear? I didn't really think any of this was what might happen, but I did have these thoughts. The whole thing made me sick. It is a very strange feeling to sit on the trading floor of a firm you built from nothing, see your traders flourish, and wish it would all just stop. And there was still more to come. The financial crisis spread to Europe, which was apparently more over-leveraged than America. The Fed cut rates to 1%, and eventually to practically nothing, a target rate in between 0 and 0.25%. The central banks coordinated cut rates. China ordered a stimulus package, and the U.S. government passed a $700 billion bailout of the nation's banks. Yes, this all really happened in less than a year. Actually, more like a few months. Talk about a trading opportunity. Anyway, enough of the painful history lesson, and back to trading. At the start of 2009, shorting the new intraday low, particularly in GS, would manifest a 50-cent rip. See Figure 4.2. With just this trading play of hitting the new low, you would frequently lose money. But with fully developed trading skills, you would adjust. And we did. We waited for GS to spike after the new intraday low and shorted into an up move. When a new intraday low was created, then we covered. As you progress, you will get better at the plays that you are taught or learn. You will learn to trade with more size incrementally. You may stumble across a new play here and there, but almost all of the money that you make as a new trader should be from statistically measured, basic trading plays. Think of it as the first few pages of a high school football playbook. Basics up front, advanced stuff later on. On our desk, these are the plays that our partners and senior traders use every day to make money, and have been using for over a decade. Support plays, breakout trades, consolidation trades, range plays, momentum trades, trades to hold, etc. Master the basic trades first. When traders overlook the basics when confronted with low-hanging fruit, I can't help but get angry. One time, Steve and I met with our core traders about missing a trade in MON. MON offered 3 easy trades, and the partners and our head trader were in all of them. The core was not. Unacceptable. It was not so much that our core traders missed the trade. Hey, that happens. Trading is not easy. Rather, it was their poor listening skills. Steve, G-Man, and myself called out these trades on our internal intercom. Our desk ignored the guys who have made millions over their careers. They were yapping with the other guys on our desk who have, well, not made millions in their career. This concerned me, so we had a talk. Let's just say it was a one-way conversation. Our desk is saturated with talent, but talent absent hard work and good listening skills is not rewarded by the market. Our desk was not listening to a suggestion from their bosses on MON. They were in some dopey BAC support play and some mediocre MGM trade. They were doing their own thing, all against their self-interest. T-Bone, the ticking time bomb. Let me offer another example. When SMB first started, we ran our desk more loosely, and our barrier to entry was not what it is now. You cannot build a trading desk without traders, after all. So we invited some folks to join who claimed to be experienced traders and gave them the benefit of the doubt. Along those lines, an experienced options trader joined our desk. Let's call him T-Bone for the Seinfeld fans and the sake of this story. T-Bone made $1,500 the first day he traded with us. Great, profits. Before the close, I checked T-Bone's work to see how he did it. His work was horrendous. He shorted a strong stock and happened to make money, and got long a weak stock and, by chance, profited. He doubled down with positions. He sold the top and bottom a few times in thinly traded stocks. He was a ticking time bomb. An intervention was necessary. Steve and I took T-Bone into our conference room and gingerly offered our analysis. His response? Guys, I made $1,500 on my first day. Obviously, I know what I'm doing. Thanks for your thoughts, though. Those were not exactly the words that I was hoping to hear. And what was worse was T-Bone's body language, which said, "What the hell are you morons talking about? Why are you bothering me?" This from a guy with 1 day of professional short-term equity trading experience. Not good. Now, to put it in context, T-Bone was arrogant. He was surly in this meeting, but he had been arrogant in his interviews as well. We took him on because we were looking for an experienced trader, and we didn't know any better. It would be hard for me to think of someone I found more unlikable than T-Bone. Very, very hard. Sensing potential disaster, Steve and I set an amount that we would allow T-Bone to lose. We then estimated just how quickly he would blow up his account. Steve set an over-under on how long it would last. I was forced to take the over as Steve beat me to the under, and Steve won the bet. T-Bone just ripped it up from that intervention on. We let him go. If you pretend to know what you are doing when you start, you will quickly just prove that you don't. You need reps. Experience will be the cure. There is only one outcome for those who pretend they know what they are doing, and that result is not a long-term future on a trading desk, or even as an individual trader. Spend your first 3 years just mastering basic trading plays and pushing yourself every day to get better. Save the new strategies for after you have learned how to trade. Be unoriginal. Survive the learning curve. Most traders struggle when they first begin. The great news is that the worst you will ever be as a trader will be when you first start, just like anything else. You have to hang in there and focus on improving. Remember, G-Man, one of the better intraday traders to hit the street in a long time, once walked into my office to quit. He soon went from "I quit" to head trader to partner. I was negative $36,000 8 months into my career, and am writing this book. Steve did not make money for his first 6 months. One of the best intraday traders on the street was absolutely one of the worst at my original firm. This trader was in the bottom 10% of our firm, and today he is in the top 1% of all intraday traders. Our most improved trader in 2009 floundered for his first 7 months and now is headed to becoming a star. It takes time to get good. I see this time and time again. Those who can give trading more time when they start have a better chance to succeed. 8 months is better than 6, and 12 is better than both. You need reps. Like Hall of Fame basketball player Michael Jordan, who did not make his varsity basketball team when he was a sophomore in high school, you must be patient. But your time will come. At the start of your trading, you should trade with small size and with one stock. You should not increase your tier size until you are positive 7 out of 10 trading days. You should set a small max loss when you begin. You should be limited in your buying power. For example, when a new trader begins, he should not write more than 10,000 shares in a day, total. Let's visit a column, Genius: The Modern View, written by David Brooks of the New York Times to offer clarity for a trader's need to be patient when they begin. Mr. Brooks once wrote insightfully about the modern genius model. Basically, we are not born great at anything. It takes concerted practice to become great at something. He wrote, "The key factor separating geniuses from the merely accomplished is not a divine spark. It's not IQ, a generally bad predictor of success, even in realms like chess. Instead, it's deliberate practice. Top performers spend more hours, many more hours, rigorously practicing their craft," wrote Brooks. We are not born great at anything. You were not born a great trader. Sorry to that interviewee who claimed trading was in his blood. Tiger Woods was not born great. Tiger had a father intent on improving his physical and mental skills. And today, after numerous majors, fame, generational wealth, this is his daily practice routine. 6 a.m., lift weights for 90 minutes. 7:30 a.m., breakfast. 9 to 11 a.m., hit balls on practice range. 11 to 11:30 a.m., putting. 11:30 a.m. to 12:30 p.m., play 9 holes. 12:30 to 1 p.m., lunch. 1 to 3 p.m., hit balls on practice range. 3 to 4 p.m., work on short game. 4 to 5 p.m., play 9 holes. 5 to 5:30 p.m., hit balls on practice range. 5:30 to 6 p.m., putting. Not convinced yet that you are not going to be a great trader on day one? Let's check out Malcolm Gladwell's page-turner Outliers. Mr. Gladwell explores the commonalities amongst the uber-successful. Those that Mr. Gladwell studied all worked at their craft for at least 10,000 hours before they were great. Microsoft founder Bill Gates, Tiger Woods, musical sensation The Beatles, and Intel founder Bill Joy all had extraordinary opportunities to practice their craft, which was responsible for their greatness. Gladwell explains, "Working hard is what really successful people do." And in yet another example of analysis, Jeff Colvin in Talent is Overrated, What Really Separates World-Class Performers from Everybody Else, wrote that deep practice, often with continuous feedback, is necessary to become great. Concentrated practice is key. Not to digress too much, but let's explore the world of tennis with my friend Daniel Coyle in The Talent Code. Greatness isn't born, it's grown. Here's how. For further evidence that you must remain patient to become a solid trader. Russian women accounted for half of the top 10 ranked players in the world in 2007. Wow! 3 of those players were produced by Spartak, a dumpy club where they felt lucky if the heat worked. Their secret? Deliberate practice on technique, constant critical feedback, and improving weaknesses. At Spartak, passionate instructors focus on the brickwork of developing the skills of their students. Players start at 5 years old, so they have practiced for at least 10 years before we ever meet them at Wimbledon, or better yet, the U.S. Open out in Flushing Meadows. If you want to be good at something, practice. Practice deliberately and do so for many years. Okay, so you don't like sports. Let's use an example from trading. After all, this is a trading book. In Edwin Lefebvre's classic Reminiscences of a Stock Operator, we read, "Years of practice at the game, of constant study, of always remembering, enable the trader to act on the instant when the unexpected happens, as well as when the expected comes to pass." So I guess you got to practice as a trader also. Sorry. Focus on improving every day. I know of no more encouraging fact than the unquestioned ability of man to elevate his life by conscious endeavor. Henry David Thoreau. As a new trader, it is tempting to focus solely on your profit-loss to judge your progress. There is a big scoreboard on your trading platform that is hard to ignore. Plus $300, negative $700, plus $1,500. This scoreboard never stops offering feedback. Do yourself a favor and cover up your profit loss. It is not significant when you first begin trading. On most advanced trading platforms, there is an option offered to etch out your profit loss. If yours doesn't, then go old school and use some masking tape. Seriously, go find some masking tape and slap it on your trading platform. Your goal is to develop skills first, make money second. You have to focus on getting better every day, day after day. Let's bring in a former trading colleague of mine. Back in the day, I love saying that, by the way, but it reminds me, too, that I'm older than most of those I work with. The trader who ended up best was, at first, considered a wuss. He was hesitant to enter the high-flying internet stocks. He was timid to size up with certain plays. But you could always find him talking to the better traders. He was always working on strange things that others weren't. I remember small things, like getting a glare guard for his computer so he could concentrate better. He started making the spreads in his own stocks with size, like a market maker. He could write down reams of notes in his journal. He started dipping his toes into the big boy stocks. He started adding size that others could not handle. And soon he was the top dog. Your goal every day is to improve. Each day is a gift from the market to improve. Work hard. Each day is an opportunity to get better. Focus on the process. Ask thoughtful questions. I understand that there are many retail and individual traders who work from home. Not everyone has or wants the opportunity to start at a prop desk with experienced mentors. But for the individual and retail trader, let me share some advice from an expert. Dr. Brett Steenbarger at TraderFeed once wrote, "There is no question in my mind that if I were to start trading full-time, knowing what I know now, I would either join a proprietary trading firm or would form my own virtual trading group by connecting online and in real time with a handful of like-minded traders." Borrowing an idea from Secretary of State Hillary Rodham Clinton, it takes a village to raise a trader. You need a network that can add value. To whom can you turn to ask trading questions? Your mentor or trading community does not know what you do not know. They cannot read your mind. If you do not understand something, then ask. You must understand one concept to understand another. It is like building a house brick by brick. One well-formed brick helps support the next brick. If one is weak, then the others are in jeopardy. Traders cannot skip steps in the process. It is one foot forward and then the next. Master one topic and then, and only then, move on to the next. When I lecture our new traders, I instruct this is not an exercise for me to practice my presentation skills. And if you've ever watched me on StockTwits TV, they are obviously superb. Kidding. This is an interactive learning experience for my mentees. Questions are encouraged so that we teach better. Also, thoughtful questions improve the learning experience of others in your class. It helps others on our desk learn. In this day of thousands of trading blogs, StockTwits, Twitter, Facebook, IMs, email, Blackberries, and by the time this book is published, whatever new social networking application is hot, the iPad, you can reach an expert in any field. Bloggers will respond to your questions. I developed a relationship with Dr. Steenbarger by emailing him questions, which led to a phone call and then a personal introduction. Without embracing this new technology, we may never have met. Jack Welch, the legendary former CEO of GE, once informed me on Twitter that his wife, Susie Welch, and he were to speak at the 92nd Street Y. I instantly bought tickets. Mr. Welch didn't actually inform me personally, but what's the difference? I had an evening with Mr. and Mrs. Welch. I would never have known they were speaking at the Y if I did not embrace Twitter. I gained an opportunity to ask them questions about running a business. We have access to people whom we didn't in the past. You must take advantage of this wonderful technology to interact with experts. I had a question about a trend day, so I reached out to Corey Rosenblum of Afraid to Trade. Steve had a question on psychology and reached out to Dr. Steenbarger. He received a quick response. I am asked questions by new traders every day, and I answer every one. Boy, am I going to regret that last sentence. Your learning experience is as good as you make it. There will be things that you do not understand. This is common. What is not okay is to ever leave a lecture or move on from a topic without mastering it. And if this means questions asked to your mentor, then this is your responsibility. Please ask. Talk shop. Outside the office at social functions, there are inevitably those who only want to talk about what they do for a living. When traders gather, since they tend to be passionate about what they do, there is little discussion but trading, other than the game on the TV in the bar. When these moments happen, whether informally or formally at some industry function, you ought to discuss trading setups. What did the others in your community see? When you talk to other traders, concentrate on exchanging important levels in stocks, how your orders were treated by the specialist or market maker, your best play in a stock, what they noticed that you might have missed. Especially share the patterns that you notice. By offering your advice, you get great advice back to you tenfold. It's a karmic exercise like anything else. How do you spend your time? G-Man, Joe P., and I traded QCOM after hours, CHOP, and then I hopped on the subway much earlier than usual to head uptown. It was a road trip for SMB to experience Avatar on the IMAX with 3D glasses. On my ride uptown, I overheard some new day traders from another firm talking. I found their conversation unproductive. 3 20-something new traders stood bantering away. Did they discuss QCOM after the close and the repeating ARCA and then NASD sellers who would not lift? After chopping up this play, G-Man exclaimed, "That was a 3K play." And then he sat and started to replay how he will make that happen next chance he sees this pattern. Joe P. joined in G-Man's quest to better trade this after-hours trading pattern. Did these new traders discuss the down move of CAT below 53.50 and the double bottom at 51.25 that fueled an impressive up move into the close? Did they discuss crazy Apple today? At one point, I thought we might see 225. At another point, I thought we might find 195. At other times, a few thousand shares moved Apple 50 cents. I tweeted, "If you want to know how the markets would trade if we passed transaction tax, watch $Apple, no liquidity, $. How about the bounce into the close? How about the failure to close below SPY 109? How about the amazing new iPad to be offered by Apple? How about Congress grilling Geithner? The President's State of the Union? The Toyota recall? The bullwhip effect on the front page of the Journal, and that Steve highlighted during our AM meeting? The Fed decision to leave rates unchanged? What to trade tomorrow?" After this day, these new traders, with an audience of other well-educated traders and a 30-minute subway ride ahead of them, decided to talk about what? You learn so much from talking trading with other traders. Right after the close is the best time to talk trading, as your mind is fresh with specific details about trading patterns. By listening to others discuss their trading, you can learn a trading pattern that perhaps you can use. You can gain information about important levels in stocks you may not have traded. You can learn how some stocks may trade. You can get a different perspective on perhaps the same stocks you were trading by swapping war stories. And on and on and on and on. And look, these guys were very polite, bright, ambitious traders. They work at a very good firm, and I wish them nothing but the best. But they had a choice how to spend their time during that subway ride. And they chose to talk about? It wasn't anything to do about making them better traders. They talked about how much others at their firm were making. It was impressive how much they knew about how much others were making. Your life is what you do, and not how much you make, where you sit on an airplane, who your parents are, or where you live. It is also partly how hot your girlfriend is. If your goal is to become an elite trader, then your time is a very valuable commodity. It is the most important commodity that you have. Use it wisely. Act in your self-interest. Be focused on all things becoming a better trader. Talking trading with other traders in your firm is a great way to get better. By the way, SMB loved Avatar. Amazing visuals. An incredible movie experience. I would tell you what disappointed Dr. Momentum about the movie, but I'm not sure if that is even appropriate for a blog, let alone a book. A great gift of the Internet is the many excellent trading blogs out there. See your bonus material for a list of blogs I recommend. Post comments on these blogs. Start a conversation. Go to Twitter. Follow traders whom you respect. Read the articles that they suggest. Comment on their tweets. Barry Ritholtz, in an interview with Damian Hoffman from Wall Street Cheat Sheet, shared, "One of the things I've loved about Wall Street is people are incredibly generous with their time and expertise. There is a mentoring relationship you can develop with people, and they're top-notch. You don't have to work at Goldman these days to have access to quality traders. Talk trading." Develop a daily work plan. Trading is not a 100-hour-a-week job. At least, it isn't for me. It certainly shouldn't be. Trading is as close to being a professional athlete as I can think of. You must be well rested. Your performance changes from day to day. Trading, like sports, is performance-based. Traders who trade well, just like athletes who play well, are paid more than they deserve. A trader must recharge after the trading day. You must be fresh and alert for the next session. Save the 100-hour work weeks for the investment bankers, lawyers, and analysts, and partners of trading firms like me. Turning one trading day of experience into 10. Improving as a trader requires skill development. As traders, we may arrive at our trading desk, sit down, and trade. That is one day of trading experience. But what if you could take that same trading day and turn it into 10 days of trading experience? Interested? Well, developing a daily training schedule does just that. We have learned from prominent authors Gladwell, Colvin, and Coyle that to become great at anything requires deliberate practice working at your craft. As traders, we can develop such a learning schedule to improve our results. We can find ways to stimulate trading to get better. Traders can do the following to stimulate trading. Keep a detailed trading journal. Replay trades in your head like old-school traders. Talk trading with other traders. Use video review individually and as a group. Practice on a trading simulator, Secret Project X. This simulation can turn one day of trading into 10+ days. Shaun White, the Olympic snowboarder, used simulation before the Vancouver Games and exclaimed after a day of optimal practice that he experienced a couple years of riding in one day. Let's use a trading example to demonstrate how we as traders can turn one day into 10+. Example, Toyota, TM. One trading session, Toyota had a full-blown crisis on its hands. As had been widely reported, sticking gas pedals and potentially dangerous floor mats caused Toyota to recall 5.3 million vehicles since the fall of 2009. Including some of its most popular models. TM was gapping down. During this intraday, while I was babysitting LXK, Carlton, one of our hard-working new traders, called out TM, Toyota. Quietly, he asserted, "Watch Toyota, it is below 75. I punched up TM. Below 75 was broken on the long-term and intraday charts. We had fresh news with their recent large-scale recall. Spencer chirped 70 was a downside possibility. TM would not trade below 74.75 on the tape. A significant buyer was supporting TM, though broken and fighting awful breaking news. Finally, the buyer left and I started a trades to hold short. 3 points of trending downside opportunity followed. I made a chop on this trade. This may appear like a layup trade at first glance. The best trade was below 74.75 after the buying stopped. Skills to read the tape and enter with the best risk-reward were required. There are subsets and nuances to learn for this one trading setup. It takes practice to develop the skill to handle the subsets to all of these trades. Simulation is how we can practice as a trader. Once in the trade, a developing trader needs to ask, when do I exit? A trader needed to decide when to cover. Perhaps when the intraday downtrend was broken? Perhaps after the first significant down move just below 74? Perhaps when any strength was spotted on the tape? A trader needed to read his charts to confirm the downtrend using multiple time frames, 1-minute, 5-minute charts. A trader needed to be glued to a newsfeed in case of an announcement of an unexpected upgrade or defense of the stock by a Tier 1 bank, which would have caused a reversal. Some traders may have been poised to cover if they spotted significant buying on the tape, so they did not lose an excellent risk-reward setup. What was the overall market doing? TM is an ADR, so how does this matter? What was the automotive sector doing as a whole? Was the overall market strong, making it less likely for TM to trade lower? This was a short below important technical support play. If you hopped on the subway, came to work, found this setup, and made this trade, then that was one experience. One rep trading this play. It would take an awful long time to master this trade at this rate. You might only see this trade once a week. But with simulation, a daily learning schedule, you can turn that one experience into 10 plus. As a trader, you can transform one day of trading experience into 10. What if you did the following before you left work on this trading session? Made detailed notes in your trading journal. That's 2 experiences. Discussed this setup with others on the desk in the play. Now 3 experiences. Replayed the trade in your head. And 4. Watched your video recording of this trade. Now 5. Met in a training room and watched video of this trade with a group. And 6. Visualized making this trade after the close. And 7. Practiced this trade on a dedicated simulator such as our secret Project X. And 8 and 9 and 10. With just this one trade, you can turn one trading experience into 10 plus. Developing a daily learning schedule can transform one trading day of experience into 10. In 6 months, you can gain 3 years of trading experience following a daily practice routine. Or you can head home after the market closes, flip on ESPN, play video games, grab drinks with friends at a local pub, and let one trading day of experience linger as one day of trading experience. Bounce back from defeat. All traders have bad days. There are still days when I feel abused. There were days where I would just go home, sit on my couch listless, and watch the Yankees. A sense of failure and guilt would consume me. I was a prisoner in my own guilt house. CPTs will be profitable 80 to 90% of their trading days, but that still leaves 10 to 20% of trading days when they will lose money. Some days you will get stopped out. They are inevitable. There is a very fine line between a good trade and missing a trade, especially when your trading frame is as short as mine. A second can be an eternity in intraday trading. We are talking many fractions of a second, which may be all we have to enter an excellent risk-reward opportunity with some trades. And some days you are just off. In the past, I have sulked after a poor trading day. I can remember sitting on my couch, sick to my stomach, mentally abusing myself with, "How can you be so stupid? You call yourself a trader? You ought to stop that. It is not possible that anyone could be worse at their job than you." Traders are great at really beating themselves up. After one of my favorite athletes, Phil Mickelson, blew a chance to win at Winged Foot by overcooking his driver on 18, he said in the press room afterward, "I'm such an idiot. I can't believe I did that." I knew exactly how he felt. This is the raw emotion right after combat. But then you have to move on. You must take some time, let go of these feelings, and start to work on getting better. And when you gain maturity as a trader, you will learn the importance of seeing your failure as an opportunity to learn. What can you do starting right now to get better? How do you eliminate your mistakes from today? Every rip can make you a better trader. Embrace these tough days as a learning experience. Thank the market for offering this opportunity. One of my favorite traders we will call Playmaker. He is 300 pounds plus. He was a starting defensive lineman on his college's football team. Playmaker bounces at a bar on the weekends. I doubt there are many scuffles where he works in Hoboken. And he knows I love it when our guys fight till the end of the day. Often I challenge, the day doesn't end until 4. If you are down on the open, you make one good trade and then one good trade until the bell rings. You don't pick up your stuff and head home for the day. You don't complain or pout or feel sorry for yourself. The market doesn't care. Let me offer a few back-in-the-day trading anecdotes to give you some inspiration to sit in your seat the next time you start being negative. I have seen Steve down on multiple occasions more than $100,000. Once he finished positive. One of the best day traders from back in the day, let's call him Happy Prince, he was known for getting ridiculously good prints, was down close to $100,000 one trading day and approached his manager. Happy Prince announced, "I think I'm going to head home." This manager recommended that he stick around and chip away at his losses. Talk about a great recommendation. Happy Prince, down near $100,000, finished up $65,000. So one day, Playmaker starts down $1,200, and he stays with it. By the close, he finishes flat. We talk after the close, and he says, "The market doesn't close till 4 o'clock, right, Bella?" That is some good stuff. That is what I like to hear. That is showing some heart, hanging in there and showing the toughness, the resilience to be a good trader. One trading session, a new trader started down $100 and then finished up $200. He had just started. I made a loud, huge deal about the skill he was now developing. His PL swing was not important. It was that this talented new trader had now learned how to fight back, trade after trade, to prevent a stop-out. He showed resilience. Resilience is a skill developed, and it reminds me of my favorite Thomas Paine quote, "The harder the conflict, the more glorious the triumph. What we obtain too cheap, we esteem too lightly. It is dearness only that gives everything its value." The day doesn't end until 4 p.m. Adam Gurin, one of the best young prop traders in the business, who once made Trader Monthly's top 30 under 30 list, said in an interview with a popular trading blog, Wall Street Cheat Sheet, "As a novice trader, it is important to be resilient. You're never going to be right all the time. That's hard to swallow for a lot of novice traders." Mr. Gurin, a former professional soccer player who trades international equities around the clock at First New York Securities, counseled that you must learn to accept you are going to be wrong often and bounce back. Dr. Ari Kiev, a leading trading psychiatrist best known for his work with Olympic athletes, and top equities trader Stephen Cohen of SAC Capital, in his book Trade to Win, wrote, "The trading arena has produced its share of select super traders, market practitioners who set themselves apart from the rest of the field with one distinct advantage: mental and emotional toughness. Like outstanding athletes who stay focused, remain calm, and stick to their game plan, these master traders in this highly risky, highly competitive arena possess an edge that keeps them from being distracted by fear, self-doubt, greed, and other emotional components that can cause major losses and prevent gains from soaring to new highs. Resilience is key. A trader must be like Mariano Rivera after a tough day. They must have the mentality of a closer. After blowing a save for the Yankees, Mo, unlike fanatical Yankees fans, forgets it. The next day he does not remember his last blown save. He goes back to what he does well. Hard cutter in, hard cutter in. Just like you ought to as a trader. One good trade, one good trade. Yesterday's past rips have nothing to do with today. If we make one good trade and then one good trade, then the rips yesterday will have no impact on our trades today. Go back to work the next day with the attitude that today will be a great day, because this is what a consistently profitable trader does, and this is your goal. Eliminate your mistakes. The definition of insanity is doing the same thing over and over again and expecting different results. Albert Einstein. As a developing trader, you must note what works for you and continue to do more of this. But you must also eliminate your mistakes. At the end of every day in your trading journal, you must make a list of things that do not work for you, and then eliminate them. I learned the importance of this exercise from a former trader at SMB who we brought on in the beginning. We were lucky to have him as long as we did. He was a former market maker trying to transition to electronic trading. Often, former NYSE floor traders, sales traders, or hedge fund traders struggle transitioning to electronic trading because of their weak bidding and offering skills, or getting executions at the best prices. But PK learned quickly. PK was one of those guys who seemed to have it all. He was handsome, with sandy blonde hair and boyish looks. He was a great tennis player who had played in college. He was very bright, a graduate of RIT, and he picked up electronic trading faster than anyone we have trained who made the transition. PK's work got better every week. One day I went up to him and asked him how he improved so quickly, and he said, "I just eliminate my mistakes every day." Oh. Here I was waiting for a complex response, and PK offered something so brilliantly simple. PK left to help his wife with her business, and we fell out of touch. Let me offer a quick exercise to help with your trading. No matter what your skill level, go get your trading journal and place it next to your trading station. Draw a line down the middle of your trading journal. On the left, keep a list of things that do not work for you, trading setups that do not work, pre-market routines that are not effective, trading rules that are not helpful. On the right, keep track of what works for you. Do more of what is on the right-hand